Global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today, I'm talking to Luke Ellis. He runs Man Group, one of the world's biggest hedge fund managers. His firm once supplied rum to the Royal Navy. Now it's a giant in quantitative investing, using data and algorithms to make money. Luke competes with the billionaire titans of the hedge fund business, not just for returns, but for talent, too.
This shouldn't be about how much money you can make. We're very lucky to work in an industry where you get paid very well. It should be about how much value can you generate for clients, and what's a fair proportion of that do you get.
Luke's mild manner belies some strong opinions. We talked about the right and wrong culture for a hedge fund, why many asset managers face extinction, cutting-edge research on the quant frontier, where he wants to expand. Here's my conversation with Luke Ellis. Luke, you've got a tough job running a public company in a business, the hedge fund business, renowned for its secrecy and dominated.
Money never sleeps. So I have to put stop on profit for Bitcoin. As you can see, yesterday we purchased Bitcoin. And right now is the time to place stop on profit. Let me show everybody who bought already, who follow our trade. We purchased Bitcoin at 58,757. I need to go even to 10 minutes or 5 minutes in order to, Okay, so this is where we purchased Bitcoin. 58,757, and I'm going to place stop on profit at 59.06. Okay, it will give us 0.5% in profit. So all of you who purchased with us, who copied our trade, you need to do the same, and we're already in profit, so whatever happened, you will not lose even a penny on it. Okay, it's worth to hold position sometimes overnight. Good trade, well done, guys.
Data technology finds incredibly easy, and asset management is at heart. I mean, it's a thought business. It's about processing information, and computers are really good at that. And so, I think technology is the future of the industry. There are elements where humans can still do things that computers can't do, but we let the humans focus on those elements, and everything where the computers could do it, we empower the computers with humans doing the programming, obviously, to be able to do that. And I think it's the future, to be honest.
Your firm competes for assets, for returns, and crucially for talent. with a number of the smartest, most innovative, and successful investors of the past quarter century. I'm thinking of Ray Dalio, I'm thinking of Ken Griffin, Izzy Englander, Jim Simons, and furthermore, they've all got really deep pockets. Is that a fair fight?
We seem to be doing all right in that fight. It's the way I would say it. So yeah, it must be a fair fight. Look, I think one of the realities of all of these things is, in those private businesses, it all becomes about the individual, becomes about the person with the name on the door, and they get the massive rewards, but the money is not run by contract. Retain, empower smart, interesting people who can run the money and do the creativity for clients. And, we do a pretty good job of that. There are some people who, get attracted by sort of very high short-term pay offers, but that's okay. It's a business, right? The answer is we have a lot of people who've made a career, who've built a life at Man, who like the fact that we give them a great place to operate amongst people who behave in a high-class way, that we look after money for, as I mentioned, for people that really need us to generate returns. So I think we have a pretty good offer to very smart people, and the numbers sort of speak for themselves.
Luke, hedge funds are famous for paying top dollar, but I ran some numbers, and I was surprised to find that the average Man Group employee earns less than the average Goldman Sachs employee. How's that possible?
I don't know about it on a relative basis. Look, I think that what's really important, and I think it's something that people forget all the time, is the firm doesn't pay the employees. The clients pay the employees. The only way that we get income is from our clients, and it's from delivering value to our clients. If we do that, then there's a question of how much we give to the employees, how much we give to the shareholders. We don't have the single sort of original founder owner who takes the multi-billion-dollar check. That check, instead of going to the founder, goes to the shareholders. We think we pay people fairly. We think we pay them for the value that they generate for clients. But I don't think that, this shouldn't be about how much money you can make. We're very lucky to work in an industry where you get paid very well. It should be about how much value can you generate for clients, and what's a fair proportion of that do you get. And I spend lots of time, and I think we've built it into the culture, to get everybody to think first about delivering value for clients, and then accepting that they'll get treated fairly out of that, and they can build a long-term career with that.
Well, the economics at a top-tier hedge fund can be incredibly lucrative. As much as half the carry, the investment profit, goes to the manager and his team. It adds up to millions, sometimes tens of millions of dollars in a given year. Can you compete with that?
Well, I don't think that it's the right thing to take half of the profits for the manager. I think that the client is the one taking all the risk, and the client should get the majority of the rewards for taking the risk with that capital. At the end of the day, while you might have some money invested in your fund, the clients, if you lose money, the clients lose that amount of money, and the managers lose the opportunity to get fees. That means the client should get the...
Okay, guys, I will have to move up my stop and profit for Bitcoin up to 1%. It will be 59,345. 59,345 right here. So you already earned 1% in profit. Okay. 345. It's just right here. Okay, good. Okay, well done, guys. Speak to you later.
Last year, Chase Coleman made 1,000 times more than you. $3 billion. And the top 15 earners in the hedge fund business collectively made $23 billion. Is that right?
That is a deep and profound question. Look, one of the things that always, whenever you get to this time of the year, and we're a public company, so my compensation is 100% transparent, and I get two sets of phone calls, both of which say the same thing. I can't believe what you get paid. From my wife's friends, I can't believe what you get paid means how much. And from my hedge fund friends, I can't believe what you get paid means how little.
Well, let's take the flip side of that. Should anybody be able to make $3 billion a year doing anything?
So I think that you've got a couple of bits to that. One is, do I think that tax rates should be higher above certain levels of income? Yes, absolutely. Do I think that the rewards for successful entrepreneurs can be and should be very large? Yes, I do, absolutely. Right, and the answer of most of the successful hedge fund managers you talk about that are in that top 20 of compensation, they are all entrepreneurs who build businesses, and well done them.
25% of your senior management ranks are women, and you're committed to raising that number to 30% in 4 years. What's the biggest obstacle, Luke, to gender diversity in your company and in your industry?
The biggest obstacle is what people did 10 and 20 years ago. So, when I got to Man, I would say there was a large amount of misogyny in parts of the management team and even in the HR department. And so, no surprise that they weren't building the cadre of future leaders. And, so we had to change all of those cultural aspects first, and then start building on the people we've got and encouraging, promoting. But you have to get all the behaviors right. It's not just about, can we go and find some people and chuck them in a seat, right? I think one of the worst things people do is they take their stars and they over promote them. There's somebody or other's law that's about, you get promoted to your level of incompetence. Well, that's bad management to do that. What we do is to try to encourage them and show them opportunity and try to get absolutely the best out of everybody that works for us and make sure there are no barriers in the way to letting people succeed. If you do that, the numbers will go up. So when I took over as CEO, that senior management stat was just under 19%. It's about 26% today. And yeah, I've committed to keep it going up at 1 or 2% every year. I'd love it to go up faster than that. But the reality of it is, it just isn't because of the raw material in the industry. I don't think it helps if we sort of ran out and tried to hire 20 of BlackRock's senior women to come and work for us to say, hey, look, we've increased our senior women percentage, because then BlackRock number gone down. What we all need to do is to help the best and the brightest diverse talent in the industry to achieve what they're capable of.
We hear a lot about the virtues of scale in asset management. And Man Group is either the second or third largest hedge fund manager after Bridgewater. Is scale an advantage?
I think in simple terms, you can deliver betas from the market, and that is a valuable source of return for clients. That's what BlackRock does incredibly well. It's what Vanguard does incredibly well. And that's great. And if you want the index return, those are the right passives, are the right way to do it. We're in the alpha business, so we're about trying to generate excess return, either in an absolute basis or in a relative basis, but it's all about trying to use skill to add value and to generate better returns or better risk-adjusted returns for our clients. I don't think scale for scale's sake is a good thing. So in the beta world, where it's really about the maximum amount of assets that you can spread your costs over, it's a slightly different case. In the alpha world, if you get too big in any alpha process, the market will find what you're doing and the alpha will dissipate fairly rapidly. There will be some mega-sized players who deliver mostly passive and some things that are passive plus a very small amount of alpha. And that's everybody chasing BlackRock. And then you really do have to be in the trillions in order to compete. There won't be a dozen of those players. There will also be some people who are all about alpha. And while the assets under management will be a way of describing it, it's the sort of amount of alpha that you can generate that really matters. The hard thing is generating alpha. It's a very competitive business and everybody would like to do it. And so you need to dedicate resources to it. Our view is the number one resource you need to dedicate is technology.
You wouldn't describe Man Group as an alpha factory if you didn't believe you were delivering excess return. What about the rest of the active management industry? Is it living up to that obligation?
I think there are too many different active asset managers in the world. I think we will end up with less managers over time, without any doubt. And there are a lot of people who, the fee load that you used to be able to get 5-10 years ago for running a sort of pretty ordinary fund that outperformed 1 year out of 4, you could still charge 50 to 100 basis points of fees. That's an unreasonable fee load. And I think those business models won't survive. I think the ones where people can generate alpha, there is more demand for that alpha than there is supply. So, the fees are very stable and the business model, I think, can work and compound over time. We see our opportunity over the next 5 years, 10 years is taking market share, but I think there's lots of room for taking market share.
Luke, hedge funds are infamous for their fee structure. Some managers can still charge 2 and 20 or more. But your fee margins have been under pressure for years. Why is that?
The thing that really matters is for the proportion of the alpha you generate that you charge in fees. That's what really matters to clients. So to us, it's really important that most of the alpha goes to the clients. We think they're the ones who take the risk. They should get the majority of the alpha. So the client gets something between sort of 65 to 75% of the alpha generally. So the client gets the first call and they should get the first call. The second thing is that then gets you to an amount of fees that you're charging. And what then matters is what our cost of production is to work out whether we have a good margin for the shareholders. The reality is asset management still has very good margins in. So, we can do both very profitable 2 and 20 business and very profitable stuff that's at a 50 basis point flat fee. It's just a different thing you're getting at those different price points.
The never-ending search for alpha reminds me of Star Trek, right? Boldly going where no one has gone before. Tell me about some of the bleeding edge stuff your quants are working on.
Some of the really interesting work on the quant side is around natural language processing. There's an enormous amount of verbiage out there in financial markets and in the broader world, which might have alpha in it. It's beyond human capability to read all of that stuff. But actually, it's the sort of thing which modern natural language processing can really get on top of. And yes, they can even deal with emojis. They can even work out whether a rocket ship pointing up means something different than a rocket ship pointing down. And there's a lot of really interesting opportunity there, both to generate pure quant alphas and also to save the discretionary portfolio managers a huge amount of time so they can concentrate on the thing that they do better than computers, which is interviewing people. So that'd be one type of area. Another type of area is, we take quant processes into parts of the markets or the sort of asset world that other people sort of don't really think that they apply. And you can apply quant processes in almost any asset class, or actually any asset class, if you understand how to make it into a liquid tradable instrument. So, sort of when we had the recent snowstorms in Texas, and there was lots of sort of news headlines talking about the difference between the grid in Texas with the East Coast, the West Coast, and somewhat surprised, we have been trading those three electricity markets independently using quant processes for a long time, and to good effect, making the markets more efficient and also earning our clients a return.
Is there consistent money to be made in quant off the boom in retail stock trading, the Wall Street bets phenomenon?
Well, I certainly don't want to pick a fight with our friends on Wall Street bets. But I think on average over time, the more different players there are in a market, the better that is for people like us and for quants. And if you look across a wide variety of markets, you could see that on average for quants, the more retail participation, that has traditionally been good for them. Clearly, there were some people got the wrong side of the Wall Street bets phenomena in the last few months. And some of that was quant, mostly that in the end was around some of the discretionary people with over large short positions on individual names. I think I think increased participation is good for us. Increased volume in markets is good for us. Increased volatility is good for us. We've all got used to this idea that there's these sort of incredibly low volatilities. And it all, I think, starts from basic economics, that when you have all governments and all central banks following roughly the same policies, economic policies, and those policies involve very high future transparency about what they're going to do, and they are all essentially cooperating, which has been really what we've seen for the sort of most of the 20 years of this millennium, the first 20 years of this millennium, then it's no surprise that we got less and less economic volatility. What you've seen starting, well, you can choose your starting point, but I would say starting with Trumpism, but then certainly exacerbated by what's happened in the pandemic, and obviously in the UK, exacerbated by Brexit, is that you've got central banks operating very separately to each other, governments following quite different policies. And so the place where we are in coming out of this virus is very different in different countries, and the speed of it working is different. And so, and what countries have done to their balance sheets quite different. And so I think both intra and intra country economic volatility is going to be much higher for at least the next couple of years. And that's going to lead to more volatility in markets.
Luke, machine learning and artificial intelligence were supposed to revolutionize quant investing, but so far they haven't, at least as I understand things. Why is that?
When you look at financial markets, the vast majority of what's happening is just noise, right? There is an enormous amount of trading or movement in share prices intraday, one day to the next, even over time, which is just noise flowing through that. And artificial intelligence has a natural tendency to want to try to create a pattern in everything. And so it creates a pattern in the noise, but that noise is not very, it's noise. So there isn't a pattern. There's a short-term thing you can apply it and then it drops off. So that's a tough problem for artificial intelligence and machine learning.
Are you surprised at how poorly some quants, even the top-tier firms, did in 2020?
I think that there are two enemies of long-term success in quant investing. And it doesn't matter how good your brand is, because it's not about your brand. The first is taking too much money in. And if you take too much money into a strategy, basically what happens is the market finds your footprint, and then your alpha turns into a risk, not a source of return. And secondly, if you don't continuously invest, it's very easy to come up with some good ideas, raise some money, sit back and count the pennies and start deciding whether you want to buy yourself a plane or a boat. The trouble is markets are continuously evolving and competition is continuously trying. And so if you're not consciously trying to innovate and you're not investing in that innovation, then what will happen is your alphas will decay. Suddenly you're left with a whole lot of money without alpha, and then you end up making some big losses.
Quant, however, can be confusing if we looked at it as a spectrum. And at one end of the spectrum, I'll put Renaissance Technologies, the firm founded by Jim Simons. And at the other end of the spectrum, I'm going to put AQR, run by Cliff Asness. Where does Man Group fit in between them?
We would love to be 100% idiosyncratic alpha. It's just incredibly hard. And you always find a certain amount of factors sort of slip into what you're doing. And we have the longest and most successful track record in momentum investing in futures markets. And, you know, why wouldn't we continue doing that? It would be silly to stop it. It's good. So, you know, I think on your spectrum, we would be 70 or 80% down towards the end that would have a medallion and a 2 sigma and less so at the what I would think of as more the AQR Bridgewater end.
It makes me wonder, why hasn't Man Group used its technological prowess to build a business in passives? You could.
We could. I think 2 things to it. One is, you know, it's an Uber scale business, and maybe we coulda, shoulda, woulda done that 15, 20 years ago. And, you know, look, the man had the cash on the balance sheet to buy BGI when BlackRock did and passed and BlackRock won, right? That's a, you know, coulda, woulda, shoulda moment. I think but now it's too late to start a passive business. I don't think you can compete. And secondly, our quants are, they have a very, very high intellectual standards. They like to work on complicated problems. And, passive is a very important asset class for clients, but it's not a very complicated problem. And they like to be thrown really complicated things. When you throw them a Rubik's Cube, they debate as to who can do it in under 5 seconds, which is a quick time. But it's sort of it's not intellectually interesting to our people.
Luke, it's a pleasure. Thank you very much for taking this time to talk to me.
It's been great fun, Eric. Thanks.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today I'm talking to Dawn Fitzpatrick, Chief Investment Officer at Soros Fund Management. She oversees $27 billion for the legendary George Soros, money he uses to fund his philanthropy. Soros himself was among the most fearless and feared hedge fund managers. Dawn is determined to rekindle that ambition and to shake her reputation for being conservative.
When there is a dislocation, we're prepared, to not just double down, but triple down when the facts and circumstances support that.
Dawn is among the most powerful and influential women on Wall Street. This is what's on her mind. Where to invest as the world emerges from COVID-19. The right way to think about ESG. The shocking way some corporate CEOs act towards Soros. Leveling the playing field in finance. Here's my conversation with Dawn Fitzpatrick. Dawn, Soros Fund Management is the greatest name in macro investing, a name synonymous with fearlessness and audacious trades. This, after all, was the hedge fund back in the day that broke the Bank of England in 1992. But the words people use to describe the firm today include conservative, safe, and unambitious. Has Soros lost its appetite for risk?
Absolutely not. Back in the spring of 2020, we put over $4 billion to work into the dislocation. When there was a buyer strike, we were the provider of liquidity, and that is not being conservative. We lean into dislocations, and I think if you look at our returns over the last 12 months, again, they speak to really taking advantage of an opportunity set and leaning in. And the other thing I'd say is when you look at the asset management industry generally, a lot of the big platforms that can trade across asset classes have mechanistic stop losses, whereas one of the things the team and I have really focused on is making sure that when there is a dislocation, we're prepared, to not just double down, but triple down when the facts and circumstances support that.
So if the returns prove otherwise, what are they like?
So over the last 12 months, we're up just shy of 30%, and we have performed both in private and public markets. And again, I would put our returns and the quality of the returns we produced up against any asset manager or any hedge fund. The team did a great job executing. And again, we played our own game versus playing kind of the game that everyone else can play.
So if conservative, safe, unambitious are the wrong words to describe Soros Fund Management, how would you characterize it? What are the right words to use?
So this platform is just incredibly differentiated, I think, from any other pool of capital in the world. And I think really what we've been focused on is our competitive advantages. And by the way, there are a lot of them. First of all, in the asset management industry, most investment mandates are very, very tightly defined. And usually you have hundreds, if not thousands of clients, and you kind of have to play to the lowest common denominator. Versus at SFM, we have $27 billion of effectively permanent capital. Over 90% of those assets are the open society foundations. So we can invest anywhere, any asset class, and connect the dots across those asset classes and be extraordinarily nimble when there's a dislocation. But also, we can invest, we can hold an asset in perpetuity. Most private assets have to have an exit in 5 to 7 years. We can be a holder that's incredibly long-term. So this platform is really, really unique. And what we've tried to do is play to those advantages.
Give me an example. What's one of those differentiated investments? Could be something bold and daring, or could be just something you wouldn't see anywhere else.
So in March, when really what the once kind of unimaginable was happening, and you had mortgage REITs being forced sellers and forced deleveraging, we were able, in a matter of 48 hours, bid on multi-billion-dollar portfolios. We could underwrite them, we could fund them, and buy them. And again, it's a moment in time, post the financial crisis, the amount of capital that can be that nimble is just significantly smaller. Bank balance sheets are very, very pro-cyclical. So our ability to show up in a big way, and make big bets, I think is very differentiated.
Would you say you're having worked at a hedge fund yourself, would you say you're as nimble as a hedge fund can be? I think we are more nimble. So think about the biggest multi-strategy hedge funds in the world. They tend... The Citadels, the Millenniums, the .72s.
All of them, they run levered balance sheets, and they typically have very mechanistic stop losses. So they really are not built to lean into a March dislocation, at least not in the first or second inning. Versus we really are built to do that in a really different way. There's big sovereign wealth funds that can do it, but they're slow and lumbering, I would argue.
Do you have return targets?
No, so as an investor, I think return targets are a little bit dangerous, right? Because in the absence of a good opportunity set, you'll lever up at the exact wrong moment in time. That said, the foundation's spend on average is about $1.25 billion, and because of COVID, 2020 and 2021 are above that level. So the team and my goal is obviously to support that spend and help the foundation continue to grow those assets.
Do you think of performance as an investor in absolute terms or in relative terms?
So I think you have to look with both lenses, to be fair. As we shifted strategically to lean into those strengths, we gradually picked up momentum in terms of outperformance relative to peers and relative to benchmarks. So 2020 was a good year for us, but it feels like the best is yet to come.
You feel like the best is yet to come. Why?
The team has gelled in a way I think that's really, really powerful. So instead of having a bunch of portfolio managers that are focused on maximizing their individual outcomes, we have a team that is truly focused on the aggregate results we produce for the foundation. And again, I think market structure, because of regulatory backdrop, has lent itself to being really, really rigid. So being able to be a provider of capital quickly and creatively is just increasingly valuable.
Don, you arrived at Soros with a mandate to make changes that ruffled some feathers, made you a few enemies, and started rumors. What changes have you made and to what end?
I wanted an internal team that was focused on that aggregate result and not individual self kind of optimization. Doing well what we could do internally, maximizing mind share, maximizing the ability to connect dots across asset classes, and then when it comes to our external allocations, really focusing on the managers who are truly differentiated. And there, as I said, there are some, but I think making sure that we had the right internal team and the right external partners was key. And I think, by the way, as a leader, I think everyone wants to be liked, but I've never needed to be liked. And I think the team and the results speak for themselves. I think our strategy was the right one, and it's paying dividends.
You have $27 billion you manage. How is it allocated?
So right now, about half of it, a little less than half, is in private assets, and the bulk of that is traditional private equity. The other half is public markets, and again, that's partially internal, about 75% internal, 25% external. I think people naturally gravitate towards privates because it prevents them from, in some ways, from buying high and selling low. When you look at the data on private markets relative to public comps and beta adjust, this is the average, not the top decile managers, there's not as much alpha as people think there is there. So from my perspective, we like the opportunity set right now more in public markets, and what we're seeing is in some cases private valuations are getting ahead of their public market comps, and I think I think you have to be a little bit careful of that. And it's something that we're watching pretty closely. All that said, there are always going to be outstanding private companies and outstanding, private asset managers. But right now, things on the private side feel frothy. On the public side, we're seeing really good opportunities.
Why do you think valuations on the private side are outstripping those on the public side right now? What explains that?
Well, part of it is FOMO. There has been some extraordinary wealth created on the private side of markets, and you see some of these valuations are incredible, and a lot of hedge funds have started to play the late private into public round, and that, by the way, that was an extraordinarily good strategy over the past 24 months. So I think there's some FOMO. I also think COVID really accelerated some secular trends. So again, some of these valuations are warranted because things that would have taken 5 years have happened in the span of 12 months.
So you described some of the things that look appealing. Broadly speaking, where are you taking risk?
So again, equity long short, we see good opportunities there. On the credit side, as I mentioned, we had leaned into residential mortgages back in the spring of last year. We're actually slowly starting to lighten up on that, and we're starting to look at the commercial real estate from an opportunistic perspective. So it feels a little early on things like retail and office, but hotels are starting to get interesting. Interestingly, on the SPAC side, for a while, when it came to their pipes, it was a seller's market, and you had to take the terms. Now it feels like pipes are going to get done where the buyers can be smart structurers, and we think that could get very interesting when the target company is attractive. So the leverage, if you will, not financial leverage, but the negotiating leverage flips from the sponsor to the pipe investors. I think we're at that inflection point. Interesting. Do you have an especially high level of conviction, positive or negative, about strategies or themes? We think the whole infrastructure around crypto is really interesting, and we've been making some investments into that infrastructure. And we think that is at an inflection point. And I think, by the way, when you look at gold price action in the context of a fairly robust inflation narrative of late, it's struggled getting traction. And I think that's because Bitcoin is taking some of its buyer base away. Do you own any Bitcoin? I'm not going to answer that. I want to know how you think about leverage on the one hand and hedges on the other. Yeah, so I think when you think about leverage, you want to think about it in the context of what is term leverage versus overnight leverage. And I think you want to think about it in terms of the assets you're leveraging and the underlying liquidity. So if you, like going back to the mortgage REITs, if you think about what the trouble they got themselves into at the start of 2020, it was about having assets that ultimately weren't as liquid as they thought and not having term around those. And when that happens, you are a forced seller at the exact wrong moment in time.
You get carted out.
Yeah, 100%.
Do you have any hedges on now?
We do, absolutely, both on the rate side and on the public market equity side.
Now, is that because you see the risk of if you will, a further deterioration in the rate market? You're hedged against higher rates on the long end?
Actually, so when it comes to interest rates, absolutely. I think, while I don't think rates are going to get wildly ahead of us, it is a tail risk that you want to be aware of, and every other risk asset in your portfolio will perform badly if that happens. The U.S. Treasury market should be the deepest market in the world, and traditionally has been. But this year, we've seen days when liquidity was really genuinely challenged, and to me, that creates vulnerability, and it creates an ability for moves that are way and outsized relative to any given headline.
We saw some of the same things in the darkest days of the market meltdown in March of 2020. Not enough liquidity in the Treasury market. What does that say? What's going on under the hood? So again, and it's interesting, a couple things. I think bank balance sheets and the restrictions on bank balance sheets matter. By the way, I thought it was really interesting that the Federal Reserve did not extend the supplemental leverage ratio. So I think that matters. The fact that the Federal Reserve has been monetizing Treasury issuance over the past 12 months also doesn't lend itself to liquidity in Treasury markets. It's almost like issuing a publicly traded stock and then having all the free float owned in one place. So I think that also is problematic. Dawn, you have said ESG matters a lot to Soros. Why?
I think we can really affect behavior because we own things at the security level, and I think that matters. Obviously, the foundation that we manage money for is and being aligned.
The Open Society Foundation.
And I should step back. So the Open Society Foundation is the single largest private funder of human rights initiatives in the world. Their mission is focused on transparency of information, government accountability, promoting democracy, equitable allocation of resources. And it's important to me and the team that the way we invest is consistent with their values. And as an investor, if you're not focused on these factors and these issues, I think you really risk being in stranded assets and being in assets where the cost of capital for those who aren't doing the right thing is going to ratchet higher at an exponential rate, and vice versa for companies that are doing the right thing by society. Cost of capital is getting cheaper.
For those trying to figure out how to think about ESG, what is the right way to think about it? Is it the right thing to do ethically? Is it a way to achieve progress or specific outcomes? Or is it just a way to hedge or mitigate externalities? What's the right way?
So I think it's all of the above. First of all, when ESG first came out, it was about your exclusion list. That is not what ESG is about. From our perspective, it's about both creating the technologies that will allow a smooth transition. So investing in companies like Rivian and battery and EV is really important to us. And then it's also about taking your existing public companies and forcing a level of transparency both in terms of greenhouse gas exposure, what their plan is to transition to net zero by 2050. When it comes to diversity, equity, and inclusion, again, shining a light, asking them to disclose what their company looks like. And from our perspective, the more transparency there is, the quicker the progress we will make.
Do they listen? Do those companies listen? Do they answer? I know why they listen and answer to BlackRock, because BlackRock has $10 trillion. Do they listen and answer to you?
I think they do, and I think we're trying to be partners. We're not just saying, hey, check this box and we'll go away. We're trying to work with them in terms of credible plans. We're telling them why this is important to us. And for us, this really is about outcomes, not about checking a box. And I think they appreciate that. And I think every CEO or CFO we would talk to genuinely wants help on this journey. And I think we can be part of that.
It goes without saying, George Soros is a living legend of the investment business. What's it like managing money for George?
So I obviously admire George before I had this role, but I have to say, being in this seat, my admiration for him has only grown. He is the most incredible aggregator and assimilator of information I have ever seen, and it is really easy to see why he, is the best investor of all time. He's 90. He's still tireless. He's fearless. All that said, he spends the bulk of his time now focused on the work of the foundation, especially now when that work is so critical. He does, he still has strong market views, and he's not shy about sharing them. And yeah, I feel lucky. I feel lucky to get them when he
does. He still put on trades?
He's not active in the portfolio at a single trade level. Again, he's focused on the foundation side.
To the degree that he's interested, what is he interested in? What do you find you and he talking about when he wants to have that kind of conversation? It's the trades that are predicated on a geopolitical view. Makes sense.
Are the ones that he tends
the foundation of his career.
Yeah, and again, his insights and his ability to gather information is pretty incredible.
George is perpetually the target of conspiracy theories. He's demonized by far-right extremists. You know all of this. To what degree does that get in the way, impede anything that you and your colleagues do at Soros Fund Management?
So, there have been IPOs where a corporate CEO has zeroed us from the book.
Seriously?
Yeah. So that has...
On the basis of political views?
Yes. That said, I just have to believe more people than not view the work George does as a true benefit to society. And I think there are more times that it works to our advantage than to our disadvantage.
I would be remiss in not asking you to name some of those companies that have X'd you out of the allocation book.
And by the way, I would love to, but I will not. I will refrain.
Don, the playing field for women in finance still is far from level. I can't say that from experience, but I can certainly see that it's the case. What do you consider the biggest obstacles to advancement for women in finance or investing, whichever you prefer? And what needs to change for those obstacles to disappear?
So I think this is a really important focus, and it's interesting when it comes to women and other underrepresented groups in the asset management and financial industry. I think there's been a narrative, and especially around women, that it's about attrition. McKinsey has done some of the best work in this area, and when you look at it, it's not, the data doesn't really say it's
not people taking themselves out of the equation.
Not first order. What the data shows is it's the first couple rungs in a person's career that are hard to get over. So for women, they are 24% less likely to get the first promotion than men, even though they enter the industry at the exact same rate as men. So one of the things we're kind of committing to do, and we're not a huge organization, we're 200 people, but is to bring in women and other underrepresented groups early in their careers, and then foster them, don't just bring them in as an intern or first-year hire, but commit to fostering them over a multi-year progression to set them on a trajectory where they really can be future industry leaders and really commit to their success. But to be clear, it's about getting them over those first couple promotions. And ideally, I obviously want these candidates to stay at SFM, but one of the things we're committed to is if for their career, it's better they go somewhere else, we'll facilitate that, but we won't we'll still be vested in their success.
Dawn, I read that Blackstone approached you during a recent search for an investment chief in their hedge fund business. Was that something you considered seriously?
So first of all, when John Gray and Steve Schwartzman call, you're going to have the conversation. But I think this is the best job in the investment industry, bar none. And I hope to be here a really long time.
You ran investments at UBS Asset Management before coming to Soros. Would you ever go back to working for a bank?
You know, I hope to finish my career out here at SFM.
Well, there's quite a lot of that career left.
Hopefully.
You're on the lists of all the most powerful and influential women in investing and in finance, deservedly. How do you think about wielding that power and influence?
So I think there's a responsibility there. You know, one thing on those lists is I wish, I want to be on lists that aren't qualified by my gender, to be clear. But I do think there's a responsibility. I'm part of an informal group of really senior women in this industry, and we get together a few times a year and do Zooms and other things as well. And we spend a lot of time thinking about how to do that. And we work together. We watch each other's backs. We're sounding boards strategically for each other. And candidly, that didn't exist a couple of years ago in terms of us creating this powerful network. So I'm hoping there's more and more of that, and we're thinking about how to expand that and really watch out for the next generation of women.
Dawn, it's been a pleasure talking to you. Thank you.
Thank you very much.
Never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, EV stocks get a boost as President Biden mounts a major push to accelerate the adoption of electric cars. Tesla shares rise before closing down. We'll talk about it all with Wedbush's Dan Ives. Plus, the global chip shortage. How bad is it? How long will it last? More from my interview with IBM CEO Arvind Krishna. And social media spreading anti-science skepticism, how Facebook and Instagram are actually fanning the flames of misinformation around COVID vaccines, and anti-vaxxers are targeting women. All those stories in a moment, but first, U.S. stocks touching record highs. Bloomberg's Kriti Gupta has the full picture. Kriti, break down the day.
Well, Emily, you saw a lot of green on the screen, the S&P 500 in the green, of course, positive trading, and a lot of it on the surface looks like it's very tech-driven. You can see the New York FANG index, the index housing some of those big tech names, up 1.4%, but not substantially higher than the S&P 500, and that's really because you saw a lot of sectors in the green, not just tech, even energy at the top of the pack. But I really want to show you what the EV space was doing and what it has been doing for the past year, because a big question going into today's market session was how much of Biden's infrastructure plan and push into EVs is priced into the market. And just look at this chart here. You can see that really since Biden's election back in November, you've seen this major run-up until some stagnation at the start of the year. So it really tells you that there has been a lot of that priced into the market. The question is, when we come back and start that new quarter of positioning on Monday, will we see that EV space continue to rally? Now flip up the boards. I want to show you some of the other pieces of the read-through from Biden's talk. Semiconductors at the top of the pack. We know they've been rallying from that chip shortage. And look, having another massive day, up 3.7%. He was also extremely tough on China. Some of those very targeted comments towards that country didn't really translate into that Chinese ADRs. The NASDAQ Golden Dragon Index, housing the likes of Alibaba, Baidu, also doing pretty good. And lastly, the NASDAQ Biotech Index, which isn't really tech in the traditional sense, but it's rallying in line with even those big tech names and things like semiconductors as well, Emily.
All right, Kriti, thanks so much for that roundup. Bloomberg's Kriti Gupta. Meantime, after a hard year for most EV stocks, as Kriti was mentioning, most getting a boost as President Biden mounts a major push to speed up the adoption of electric cars. The president's infrastructure proposal unveiled this week allocates $174 billion to EVs, including sales rebates and tax credits for consumers who buy American, in addition to various industry incentives. For more, let's bring in Dan Ives of Wedbush Securities. So what does this actually mean for electric car companies, specifically Tesla?
Yeah, I mean, this is going to kick off what we believe is a green tidal wave. In terms of the whole ecosystem, I think in terms of Tesla and GM, the reason it's important is I think part of it is they're going to lift the ceiling on the 200,000, where now you'll start to see tax credits restored for Tesla and GM. And we believe, based on all of our checks in the Beltway, that the 7,500 goes to 10,000 or potentially more. And that's why right now, this is the start of what I believe is a $5 trillion market, with definitely Biden kicking off the green tidal wave in the U.S., which has underperformed when we look compared to China and Europe.
But why this reaction in the shares today? They popped a bit midday, closing down, though, about 1%. Why did investors react that way?
I think this was a bit sort of buying rumors, selling the news. But if I look out, I think EV stocks are up 30 to 40% from these levels. Because what we're seeing in China, you saw with NIO, Xpeng, and I believe we'll see it in Tesla over the coming days, is around China's continue to see skyrocketing growth. For Tesla, that could be 40% of sales. And then you combine that with what we're seeing in Europe across the board, and of course now in the US, I think this is just a start. Even though a lot of blooms come off the roads for the stocks, I believe that's near term. And I think the good news starts as we see more deliveries and numbers over the coming weeks.
Dan, you cover Uber as well, and I'm curious what trends you see post-pandemic for car ownership, car purchases versus ride sharing.
Yeah, I think for now, especially as on a reopening play, the names like Uber and Lyft continue to be front and center, even despite some of the headwinds that Uber's seeing in the UK. But no doubt from a ride sharing, I think we're seeing a share shift. You're seeing more and more, especially in urban areas, as there's an urban migration. That's a benefit for names like Uber, especially where they play. But when we look at car ownership, I think we'll see auto sales spike over the coming year in terms of the reopening. But it's important that we're going to see a transformation on EV. Today, 2% of automobiles in the U.S. are EV. When that goes to 10% next 4 to 5 years, which is why right now it's just the start of a massive ecosystem really being built out on the auto front.
What about tech more broadly? Are big cap tech stocks really reopening plays, or has the incredible rise that they have seen over the last year, are we going to see that start to change?
You know, I think the sell-off's been overdone. I know we've talked about it. In our opinion, in terms of the reopening, take a step back. A digital transformation in terms of the shift to the cloud, talking about $2 trillion over the next decade. Amazon, Microsoft, Google, and really across the whole ecosystem with cybersecurity and some of these others. There's poster childs like Zoom that will see moderated growth. But I think we're going into a golden age for tech in terms of where we're going to see spend. And I think what we're going to see over the coming 3 to 4 weeks, tech's going to rally significantly in terms of earnings. We think across the board are going to be beat and raise specials. And I think that starts what we believe is a rally to a NASDAQ 16,000.
Does regulation concern you? We just saw the CEOs of Alphabet, Facebook, Twitter testify on Capitol Hill, and we know that more scrutiny is coming.
It definitely is in terms of big tech versus Beltway, especially on Section 230, but just broader on antitrust. We're seeing those swirls not just in the Beltway, but also in the EU and Brussels. I think for now it's a contained risk. No doubt this is going to be a long sort of 12-round battle, but I think the biggest risk for tech continues to be China. The U.S.-China cold tech war right now, I think it's a bigger risk on tech stocks. We think about 10% risk right now, a discount to tech, given the view that Biden was going to be softer on China. As we've seen, it's sort of been the opposite. So that's really going to be a fork in the road situation over the coming months.
So talk to us about some of your other more unsung tech reopening plays. You highlight in your notes Okta, DocuSign, CrowdStrike. Talk about some of the names we don't talk about as often that you think will surprise us.
I think on healthcare, there's a name like Nuance. I mean, more and more we're going to see healthcare spending increased amounts on cloud. I look where Nuance are a pure play on healthcare. Love that name sort of front and center. That could be a re-rating stock, ultimately $60, $70. Another name I like on the reopening is Cerence, which is an auto play. This really directly benefits in terms of what we see. And I think that's a name they're going to be more and more driven internationally in terms of that being almost an auto cloud play. So love those two sort of front and center. And then I think some other names on the cybersecurity side, hybrid environments, 30 to 40% working from home potentially. You're going to see names like SailPoint, Varonis on the cybersecurity side. I think get another big lift as we're starting to see out in the market.
All right. So where do you think we end 2021?
NASDAQ, I think the ball drops in Times Square, NASDAQ 16,000. I think tech stocks rally 30% from here. And it's my view, this has sort of been a golden buying opportunity. And then I get the whole rotation trade, 50-bit move in the 10-year. Doesn't change the multi-year bullish view on EV, as well as tech in terms of where we're seeing it. So I think this is going to start to play out over the coming weeks with numbers that I think will really surprise the street on the upside.
All right. Well, always love that you come to us with specifics, Dan. Thanks so much, Dan Ives of Wedbush Securities. Appreciate it. Meantime, investors are showing their loyalty to the famed ARK Investment Management founder, Cathie Wood. 2 of her exchange-traded funds, adding $1 billion in a single day this week. Her flagship ARK Innovation ETF took in a record $717 million on Tuesday. Meantime, the ARK Space Exploration and Innovation Fund took in $281 million on its first day of trading. All right, coming up, IBM CEO Arvind Krishna took over when the world was in turmoil amidst pandemic lockdowns. I speak to him next about his vision for the company's next chapter and when quantum computing will truly transform the industry. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
As vaccines are administered around the world and pandemic restrictions loosen, companies are trying to chart a path forward. IBM CEO Arvind Krishna said he expects 80% of their employees worldwide will go back to work in a hybrid model. In an in-depth interview for Bloomberg's Work Shifting Summit, I asked Krishna what the next chapter of IBM innovation looks like under his leadership and how the global chip shortage is impacting their work. We started on IBM shares, which have lagged over the last decade, and whether that will be a measure of his success.
Investors only have the one measure, which is the stock price, and that is a definite part of my own report card and the company's report card. But let's just step back a little bit. There is the strategy of what you do, and then there is the how you do it. So I've been clear, we are going to be a hybrid cloud and AI company. And then I would say, as a bit of a half sentence, and quantum into the future. So the first thing we did is we sort of took out and we're going to spin out our managed infrastructure services business. So that's part of the focus. We are a hybrid cloud and AI company. So the pieces that fit that the most stay here. The pieces that don't, we'll spin out to go get value for our investors. Next, how are you going to lean into being even more of a hybrid cloud and AI company than you are today? So we're leaning in both organic investment and inorganic investment. I've completed 10 acquisitions, all on hybrid cloud and AI in the last 11 months and 25 days. So that's one step. But we've also opened up money for investment in terms of how we are going to invest both in our own organic innovation as well as with partners. So I announced a $1 billion fund that we're going to work with partners to enable them on our platforms. So you begin to put those things together and you say, okay, you're increasing investment, you're focusing the company, you're spinning out pieces, you're acquiring companies, you're increasing your ecosystem with partners, and those should all result then in revenue growth, and we have committed mid-single-digit revenue growth in the medium term. Now you put all that together and then you begin to say that that is how you're going to value the company. And my goal is then to create a hybrid cloud platform that is even more vibrant than the mainframe and middleware was in the past, which are two platforms that we had a lot of success with.
Now, I know you're super excited about quantum, and I speak to many people who say they just don't think quantum is coming anytime soon. When will we see quantum truly transform the industry?
I give it a 3 to 5 year time period, which is not that long. So when you think about how hard that technology is, and I say that the market, so you always got to keep your eye on the economic opportunity. I think the economic opportunity, not just for us vendors, but for the people who use it, is in the $450 to $500 billion range within the decade. So then you can turn around, Emily, and say, how much of that will those of us who produce the technology get? If I go to all other technologies, 20% seems like a reasonable number. So the leaders in quantum stand to get as much as $100 billion somewhere in the next decade. Then you say, when is it going to happen? I think that it's quite real. So today you're having computers that are, they're measured in qubits, quantum bits. So 30, maybe 60 is the range for this year. We just announced a partnership with the Cleveland Clinic, who wants to use quantum computing to further drug discovery, molecules, interactions around pathogens, etc. And that's an example where it's real problems. But I'll agree with you, it's not necessarily a commercial advantage or other forms of high-performance computing or cloud today. I think that period will come in the next 3 to 5 years. We put out a roadmap to say we'll put 1,000 quantum bit, 1,000 qubit quantum computer in 2023. I think that's a bold goal. I think it's hard. I wouldn't tell you we have every problem solved, but I have a tremendous pride and confidence in our scientists and engineers. And by the way, engineers are as important here as the physicists to get these big systems working in this time period. And that's where I believe we'll then get on the roadmap towards those billions of dollars of advantage that I mentioned.
Big news in chips. Recently, you're doing a partnership with Intel as they're doubling down on manufacturing, doubling down on a foundry business. Given all of the many industries that IBM is involved with in all of your diversity of clients, how devastating has the chip shortage been, and how much longer do you think it will last?
Whenever you get a constraint in a supply chain and you find that the sources and the manufacturing is down to 1 or 2 regions, this is going to last a few years. This is not a few months or a few weeks. So we should be clear about the impact. It's going to last that long. Then you say you've got to solve it. So we are working together with Intel because we do believe that there should be alternate sources of fabrication. And we do believe there should be competitive advantages in the more advanced nodes that are to come. That's where we have our strength. So we have a lot of work on 5, 3, 2 nanometers, just to sort of categorize where we are. And just by the way, the world today is at 10 and 7 nanometers. So we're talking about the next generations. So we'll bring our advanced R&D into Intel, who will then produce the fabrication plants that can produce this at scale. And so we believe that that's a great way to work together. We also believe that that'll allow the pair of us together to be much better positioned to compete for the monies that are in the CHIPS Act, Endless Frontiers, as well as the National Semiconductor Technology Center. So those are all the opportunities in front of us that can result from the work we do together to advantage competitiveness within the nation.
IBM CEO Arvind Krishna there. You can catch the full interview at Bloomberg.com. All right, coming up, anti-vaccine groups on social media have a new target, women, and they've been quite effective. Details next. And as we head to break, let's take a look at the original FANG stocks, all in the green. The benchmark S&P 500 closing above 4,000 for the first time. Tech shares leading those gains. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Just 12 accounts on Facebook, Twitter, and Instagram account for 65% of all the vaccine disinformation on your platforms. You're exposing tens of millions of users to this every day. Why, in the midst of a global pandemic that has killed over 500,000 Americans, that you haven't taken these accounts down?
Congressman Mike Doyle there of Pennsylvania expressing frustration to the CEOs of Facebook, Alphabet, and Twitter at last week's House hearing, claiming that the social networks have chosen not to take down accounts that spread vaccine misinformation. And in our latest edition of Bloomberg Business Week, we found that the influence of the anti-vaxxers has reached a very particular demographic: women, especially women looking to become mothers. For more, I want to bring in Bloomberg's Sarah Kopit, who helped write the story. Sarah, the story was absolutely fascinating. Let's start at the high level. Why have anti-vaxxers picked women as a target?
Well, it's really because it worked the last time. Women have been the target of anti-vaxxers going back quite some time, because really the conversation before COVID-19 was about mothers and their babies with the MMR, measles, et cetera. And so what the anti-vaxxers had, their strategy at this time was really just to put COVID in front of vaccine and use the same playbook that they'd used previously, because it worked just that well. And that's what we're seeing right now, and it's resonating among so many women that Sarah Fryer and I talked to for this piece.
What did the women tell you? Because I understand you got a lot of different reasons from women who weren't getting the vaccine, and of course, the possibility of not being able to have a child was high on that list.
Yeah, so we heard the gambit, really. I think that the most prevalent one was really around safety. So people took an exception to how quickly the vaccine was produced, how they wanted to wait and see, really, and that's vaccine hesitancy, almost as a definition. And so that was a really big chunk. The fertility part was very interesting as well, and a lot of that stemmed from a blog that actually showed up on social media in early December of last year. And that blog claimed wrongly that the vaccine inhibits women's fertility. And that really found itself all over the social platforms. And that was just weeks before the emergency authorization was issued that allowed this vaccine to be given right at first to nurses and first responders. And it was a lot of those nurses that we talked to right at first. We went into nursing Facebook groups. We went online and we saw the conversations that they were having. And nursing as a profession skews very female. And that's really what they were talking about, was questions about, well, if I'm trying to become pregnant, or if I'm pregnant already, should I just wait? And that's vaccine hesitancy.
And I just want to add that there is no evidence that the vaccine has a negative effect on women or pregnant women or can harm a woman's fertility. In your view, just as an observer, how are Facebook and Instagram responsible? Are they responsible for how this has proliferated on their platforms?
So they are certainly trying at this point. but their algorithms, their business model, what they try to do is they try to reward really engaging posts, and that's what drives what you see on the platform. And we know, just because of how we've studied disinformation over all these years, that lies really do spread faster than the truth. It is more interesting, more titillating a lot of times. We saw this with, when this fertility blog went out, Pfizer did come back with an answer to this question, does it affect fertility? And they gave a very robust scientific answer full of scientific jargon that we reference in the piece. And it's hard for that type of language to really resonate on social media. You have to, we say that the people who are giving the information have to do a little bit better. They have to live in this world where, social media memes, that's what spreads. And the scientific community and the companies, they hadn't quite caught on to that yet.
All right, well, a fascinating piece, definitely worth your time in this week's edition of Bloomberg Business Week. Bloomberg's Sarah Kopit, thanks so much for sharing your story with us. All right, coming up, the first company solely focused on quantum computing is going public. Why the technology may soon be mainstream. That is next. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Tell us something you're doing that doesn't work out, where you've failed or something you can say you're not good at.
Let me tell you something. There is plenty that I am not good at and plenty that I've failed at, but I'm not afraid to fail.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
back to Bloomberg Technology. I'm Emily Chang in San Francisco. Let's get a quick recap of the market's big movers today with Bloomberg's Abigail Doolittle in New York. Abigail, take it away.
Well, Emily, you know, tech was really the story today. Big outperformance, particularly for the chips. That stocks closing up more than 3%, really outperforming almost near its all-time high. And one piece of this, Taiwan Semiconductor, they have boosted their spending plans. So that really put a bid under some of the other chip names, including Lam Research. That's a semi-cap equipment company. So they make the machinery that makes the chips. Often that's seen as an early tell. So the fact that you have Lam Research and Applied Materials, another semi-cap equipment company, is seen as a good sign. Plus, in Joe Biden's infrastructure plan, President Biden's infrastructure plan, $50 billion dedicated to chip manufacturing, trying to bring more chip business back here. So the chips really grew. Now, it's interesting, Emily, because relative to green power and EVs, a little bit of a split action. On the morning, huge surges in these spaces overall, because you can make the case that roughly $460 billion of that same plan in one way or the other is dedicated to climate change, improving the climate, green power, EV space. However, we see here on the close a little bit of a mix with Fuel Cell and Ballard Power closing down. Some of that could just be too far, too fast. As you know, Fuel Cell and some of these other names up in a huge way over the last year, actually just since President Biden was elected last November, up more than 900% at one point. It's really pretty incredible. So taking some chips off the table. And then, Emily, let's round it out with the biggest tech names, because here is why we had the big outperformance for the NASDAQ on the day, along with the S&P 500, tech being near the top sectors. It's all about your biggest companies. Microsoft, of course, getting that $22 billion contract from the Army, bringing the other mega caps higher with it. Emily, this is the catch-up trade. Tech not doing so great on the year, but right now it seems as though investors want in.
Exactly. All right, Abigail Doolittle, thanks so much for that roundup. All right, from finance to farming, space travel, and cars, the world depends on computers to crack, crunch, and deliver numbers and automate the world's most complex systems. But these computers can only do so much, and as technology and AI become more ever-present, the demand for even more powerful computing is taking off. Meet quantum. Quantum computing, the ability to compute information in a way that would never be possible with a conventional machine. In very broad terms, quantum computers can crunch and calculate scenarios at an exponentially faster rate than the common computer. These advanced processes now drawing the eyes of investors like the CEO of DMY Technology Group, Niccolo de Masi, who joined us back in December when his SPACs were in focus.
The first one was consumer, gaming, online casino. The second one is sportsbook data. The third one will be, something probably in cloud computing, AI computing, potentially even, something like quantum computing or cloud networking. The kinds of technologies really underpin the future of mobile.
That third company Demasi was talking about now, IonQ, making it the first public company solely focused on quantum computing. We're joined now by IonQ President and CEO, Peter Chapman. Peter, thanks so much for joining us. So why SPAC and why now?
Hey, Emily. Thanks for having me on today. Well, as you mentioned in your intro, quantum computing is an entirely new paradigm for computing. And as with many technologies, it requires a significant investment to bring them to market. And becoming a public company gives us access to capital and resources to make quantum a reality.
So mainstream quantum computing, though, how close is that really? We heard from the CEO of IBM earlier. He's really bullish on it. He said 3 to 5 years. I spoke to another CEO who's in a position to know, who says it is a long ways off.
Yep. Well, first, as I would say that different technologies have different horizons. Some of them, like ours, we also think is in the 3 to 5 years. But I think there's other technologies in quantum which are still 30 years away. I do think that this is the companies that make the devices are probably, have the advantage point in terms of being able to predict when they think they can bring a product to market.
So how do you believe quantum computing will change our lives as we know it and tackle real world problems? Like what will be different possible as a result?
Well, quantum computing, many people expect that quantum computers will be able to solve many of mankind's kind of grand challenges, everything from direct carbon capture to new drug discovery, new batteries, solving strong AI, improving machine learning. Since we're talking about just a much bigger computer, it's kind of hard to say where it won't be used. And I do think it's kind of an interesting question. If you were to go back to Intel and ask them in the 1970s, what did they think those little microprocessors were going to be used for? The answer back then was it was going to make a great calculator. And they couldn't really foresee the internet or cell phones happening. I think we're in that same place today for quantum. Where there's a bunch of things that we know about today that we use classical computers for. But I bet you 20 years from now, we'll look back at this and people will look at my answer and go, wow, you couldn't have imagined X, Y, and Z. And so we're exactly the same place kind of for quantum as we were in the 1970s.
You mentioned carbon capture, and I know Bill Gates' Breakthrough Energy is one of your investors. You also worked at Amazon as the director of engineering for Prime for many years, and I'm curious, how could quantum computing revolutionize a company like Amazon?
Well, so quantum computing is good at solving optimization problems with a cost function. And so it turns out many business problems can be converted into an optimization problem. So as an example, what is the optimal route to deliver a package to a consumer? That's something that logistics companies are extremely interested in, because if you can just shave off a mile or two off of a driver's daily delivery route, you can save a great deal of money. So for somebody like Amazon on the Amazon.com side, not the AWS side, they should have a lot of interest in the logistics applications for quantum. And then, of course, you mentioned Bill Gates. There, it's things like direct carbon capture, and better batteries, and even, chemical applications. It turns out that in the production of fertilizer is one of the most polluting industries on the planet. It accounts for about 1% of all the carbon emissions. But bacteria know how to do it in soils without any extra energy. So we just don't have a classical computer that can do that modeling. But with a quantum computer, you'll be able to do it. And we can unlock the secrets of how nature does it without polluting the environment. So it's these kinds of things that we think quantum computers are going to be good for.
Not to get too deep, but do you think that quantum will get us closer to the singularity where computers won't just be able to process the things we want to, but will actually be able to understand what we're asking them to do?
So, first, before I started at Amazon, I worked with Ray Kurzweil for 7 years. So I'm very familiar with Ray and the singularity, and he's a good friend. The short answer is yes. Actually, myself am extremely interested in strong AI, and I think there's good reason to believe that a quantum computer will be able to unlock that as well. So I'm particularly hopeful there. That's a little speculative today, but I think in the next couple of years you'll start to see that quantum computing can help there too.
All right, fascinating. Well, we'll be watching on your path to the public markets. Peter Chapman, IonQ President and CEO, thanks for joining us. All right, coming up, Apple's much anticipated Worldwide Developers Conference will be held again virtually the second year in a row. We're looking at what we can expect with our own Mark Gurman next. This is Bloomberg.
valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Apple's Worldwide Developers Conference, slated for June, is again going remote for the second time. The event usually marks attendees flying in from all around the world and networking with other like-minded Apple fans. Bloomberg Tech's Mark Gurman thinks, though the company is itching to return to in-person events, this one will again be remote. Mark joins us now with more. What can you tell us about the event so far this year? What will be announced and how will it roll out?
Yeah, so WWDC is typically Apple's most important event of the year. This is where they outline their software roadmap for the next 12 to 18 months or so, and it always gives strong indicators of what the new hardware is to come. So for this year, unless Apple does show an early preview of their upcoming VR/AR headset, I think it's going to be a somewhat muted event. I'm not expecting major updates to iOS or macOS. I think the updates will be on the more moderate side this year. Perhaps a bigger update to the software that runs on the Apple Watch and another incremental update to the Apple TV software. But there's also a bunch of new Macs in the pipeline. The new MacBook Pros with faster, Apple designed processors could make an appearance around that time. So perhaps the developer conference will be a good time to usher those in. So overall, I think it will be an exciting event for the Apple faithful, but I'm not anticipating anything major unless there is that preview of the headset.
How do you anticipate Apple events will change going forward? I mean, will they always be remote, or will they come back in their full glory with no changes at all?
Yeah, I think Apple events are going to come back to the normal in-person format as soon as possible. But I think they are going to do a little bit more to blend sort of the success of the virtual events with the in-person events. I think you'll get everything that was great about the in-person events, being able to go hands-on, being able to be there in person, seeing the products be unveiled on stage. But I think they're going to throw in a lot more video on the big screens in whatever auditorium they're presenting in to sort of give that virtual flavor. They'll have pre-taped videos of other engineers discussing products. They'll have videos of people going inside the labs to take a look at how the products are developed. So I think you'll see a nice combo there in the years to come.
Now, Apple and Amazon and Google, have talked more publicly about their return to work plans. We haven't heard as much from Apple. What do you know about Apple's plans and Tim Cook's desire for employees to get back to the office?
Yeah, so from the beginning, the push was to get Apple staff back into the offices as soon as possible. And Apple hasn't really talked about this, but there have been Apple employees still at their headquarters and offices around the world for essential functions from the very beginning, all the way from March, right at the height of the pandemic. And they're using a 4-phase approach to return people into the office. Phase 1 were those essential workers who were there from the beginning. And right now, the company is still in what they're calling phase 2. That means some employees are able to go in, if they'd like, into the office and work there during certain hours or certain days of the week. But there is yet to be a full force approach to push everyone back to the office. But I am expecting that to happen as early as the end of June into July after the developers conference.
Meantime, it is Apple's 45th birthday, and Tim Cook sent a letter to the company that you obtained. I just want to read a quote from it. He opens talking about the tradition of making transformative products that redefine technology. I quote, 45 years later, we mark this occasion, he writes, by rededicating ourselves to that mission and to keeping it alive for a long time to come, rather than to remember it fondly as something past. What do you think will define the next generation of Apple products under Tim's leadership?
Yeah, I mean, under Tim's leadership, so we're talking, perhaps the next 5 years or so, I think the 3 big remaining things are going to be some sort of push into the smart home, cleaning up their approach to smart homes, new home devices, a more cohesive strategy. I think the second thing will be headsets. That would be the first, VR/AR headset that will go on sale next year. And then later on, probably toward the end of Cook's tenure, they'll launch the, ultimate AR glasses, which should be a pretty hot seller down the road. And then I think a little further out from there would probably be a self-driving car or electric car of some sort. So those are the three big areas I'm looking at for, the rest of Tim Cook's leadership.
Well, if all of that comes to pass, it's going to be an exciting next 5 years or however long it is that Tim Cook continues to run the company. Bloomberg's Mark Gurman, as always, thanks so much for joining us. Meantime, we just got some breaking news. President Biden's aides have set April 12th for the date of a summit with various companies to discuss the chip shortage that we've been talking about now for weeks on this show. Again, President Biden and his aides setting April 12th for a summit to discuss the chip shortage with various companies. Companies invited to this meeting include Samsung and GM. According to our Bloomberg sources, we'll bring you more headlines as we get them. All right, still ahead. In a pandemic world where more transactions are occurring digitally, financial crimes have surged. We'll talk to the head of the tech unicorn FeedZai, which fights financial crimes using AI after an impressive new funding round. And a reminder to stay with Bloomberg for our special programming around the U.S. Jobs Report Friday. Martin Walsh, U.S. Labor Secretary, joins a panel of other economic experts Friday morning. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
As the world undergoes a massive wave of digitization, accelerated by the pandemic, FeedZai, an AI cloud-based risk management platform, has seen a 650% increase in financial account takeover scams and a 250% increase in online banking fraud attacks. Joining us now to discuss solutions for the rampant financial crimes, FeedZai co-founder and CEO Nuno Sebastião. The company recently raised $200 million in an investment round led by KKR, driving its valuation above $1 billion. So talk to us about how much and what kinds of activity you're seeing just heading into 2021.
Yeah, so first of all, thank you for having me, Emily. So, I mean, as you mentioned, we saw, these impressive numbers in increase. And if you compare, even before, we have some stats comparing Q1 last year with Q4 last year, and the amount in fraud scams, 250% online fraud scams, the amount of impersonation, so someone trying to, pretend to be you to gain access to your financial services systems or to your credit cards, over 600%. Right, so it's been rampant, and it was already happening, but with this acceleration to digital that was kind of forced upon us, and particularly in the financial services area, it really blew up, and that basically increased the demand for these type of solutions.
So the unemployment system, for example, was plagued by $63 billion in fraud as unemployment was doled out to millions of Americans amidst the pandemic. How could your technology help?
We work, I mean, I cannot say too much about that, but when we work with, classified systems or with high security systems like the one you mentioned, making sure that, the money flows and gets to the consumers, that's where it needs to go. And it's done not only in an efficient way, but in a safe way. So what we essentially do is we work with organizations to ensure that whenever they wire money, for instance, PPP loans, or for instance, the checks are being wired, sent to people, we ensure that they get to their rightful, people, and to make sure that they land in the hands of the people that deserve it and that they stand for, not used for cyber criminal activities. And we do this at scale, not only in the US, but also in many regions throughout the globe.
So talk to us about your coming plans. You're working with KKR. Any plans to go public?
So, it's interesting. So we've been approached, and it kind of speed up last year by a number of firms. And the same way they chose us, KKR chose us as we're becoming the leader in this space. We chose them because their vision is very aligned with our vision. So they pick up leaders in the different spaces they work on. And what they ensure is they understand where do we want to go. And our vision is to ensure that we become the platform for financial crime risk management across all the touch points you use as a consumer, from the moment you try to open an account to the moment you're transacting. And just to give you some stats, up to 5% of the money that flows into financial services systems is used for money laundering. We make sure that that doesn't happen or that stops. And they've realized that we would be the company that becomes that player. They're aligned with our growth. My intention is to be that independent company. If that's an IPO or if that's another mechanism, we will see. But clearly, they're betting on us winning this market the same way we're executing to that.
All right. We'll be watching. FeedSci co-founder and CEO Nuno Sebastião, thank you so much for joining us. All right, again, this hour, we've learned that President Biden's top aides have set a date of April 12th as the date for a summit on the chip shortage that has been so devastating to the tech industry. Sources saying companies invited to the meeting include Samsung and GM. We're working to find out more. And next week, we will be bringing you a very special program all about the global semiconductor shortage. It's called Chip Crunch. We will have conversations with CEOs, analysts, and of course, the best of Bloomberg News. That show, Wednesday, 5 p.m. Eastern, 10 p.m. in the UK, 5 a.m. in Asia. And speaking of Asia, we're going to bring you a special conversation with Baidu's CEO and co-founder, Robin Li. It'll cover Baidu's decade-long journey from being a search engine to a company that does everything from cloud computing to producing autonomous cars. That's tomorrow across Bloomberg Television. And that does it for this edition of Bloomberg Technology. Thanks so much for joining us. This is Bloomberg.
Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Explores how a chip shortage snarled everything from phones to cars on a Bloomberg television special, Chip Crunch, Wednesday on Bloomberg Technology.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Ultimately, it's billions of dollars from the government that will pull that vaccine through and purchase it for Americans and people in low-income countries.
COVID-19 has exposed a sickness in global society. It's exacerbated deep-rooted inequalities in the United States.
The wealth divide has just exploded in the wrong direction.
Structural inequalities is not healthy. It means we're leaving productivity on the table.
Around the world, migrant laborers are bearing the brunt of the crisis. And while rich nations are well into their vaccine campaigns, developing countries are falling behind.
We're not going to have as swift a recovery in the United States or in Europe if we don't make sure that everybody gets vaccinated.
2.5 million women have left the U.S. workforce due to the pandemic, while corporations face a growing demand to fulfill promises of inclusion.
Collectively, large companies have not done a great job on diversity.
You have to believe it's critical for your business.
As the world starts on a path to recovery, how do we ensure no one gets left behind?
The moment for radical change has arrived. Clearly the system is not working.
Trailblazers in business, technology, and public health convene to map out a more equal and inclusive future. It's time to move from words to action. This is the Bloomberg Equality Summit.
Hello, I'm Carol Masser. The Bloomberg Equality Summit was held virtually as the U.S. marked 1 year since the start of the COVID-19 crisis. In the first months of 2021, new vaccines hold the promise of a return to normal. Even so, it's clear greater efforts will be needed to repair the social and economic damage of a pandemic that has exposed and deepened inequities across gender, class, and race. Leaders at the front lines of industry and policy came together at the summit to discuss how companies and institutions can work to close these gaps and bring about lasting change. The process starts with recognizing the stakes of the challenge.
It's become a vicious, destructive cycle where inequality has fueled the spread of the disease, and then the spread has created both health, economic, and education inequality that further fuels inequality. So I think the moment for radical change has arrived. You know, clearly the system is not working.
Everywhere you go, the majority of people believe that they should vaccinate their own country first, and they struggle to understand sometimes how important it is to open up economies in other countries, because, you know, every country is dependent on imports and exports.
The economic impact of the pandemic has fallen disproportionately on women's shoulders. For the first time in history, for example, the economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
This is not about doing a favor for women, people of color. This is about EPS. This is about higher EBITDA. This is about business, because we know from the research and the evidence that companies that are more diverse are more profitable.
One thing that COVID has revealed to all of us is that racial equity, structural racism is a thing. It always has been.
Listen, I think George Floyd and the uproar around George Floyd, when everybody saw a man get murdered in real life.
I am one who hopes that what we saw last year in terms of the uprising against the social injustice and the racism in the United States as well as in other countries, perhaps, and I hope, has reached an inflection point.
Women have had the most devastation, women and people of color, during this crisis. And so if we're going to have a full response and a swift response, we have to stop thinking as a world of gender equality as this nice thing to do when we get to it, or this side issue. No, it is the central issue. We are in a crisis for women and people of color in this country.
The Bill and Melinda Gates Foundation has been supporting vaccine research and global public health initiatives for decades. So co-chair Melinda Gates is well aware of the structural inequities complicating the fight against COVID-19. She shared how the vaccine rollout is progressing with Bloomberg's Emily Chang.
We still have a ways to go. You know, we're seeing the light at the end of the tunnel here in the United States, but until all Americans are vaccinated, we still have a ways to go. But, you know, it's going to be a while until the entire world is vaccinated. So this is going to still be with us the next few years. And I think we're going to have to really watch these variants that'll be bouncing around the world. That's actually still quite concerning.
What is it about the variants that concern you?
Well, because every time we know viruses mutate, but when they mutate, you know, they can become sometimes more deadly or more contagious. And so anytime you see these mutations, we need to be on top of them in terms of surveillance. And then we're going to have to figure out, do we need to tune various vaccines to take care of them?
Your foundation has committed $1.75 billion to the fight against COVID. I know your team is very diligent about looking at where and how that money is spent. In your view, where is the vaccine rollout working and what's not working?
Well, I think it's working in some of our high-income countries. We're starting to finally see, you know, much broader distribution, for instance, in the United States and in some of the European countries, but it is not at all working yet for middle and low-income countries. And, you know, those are places where people are struggling. They have their loved ones who get ill. They can't get them to a hospital, much less an ICU. And so they are really still struggling in many countries around the world.
So there's obviously a moral case for vaccine equity, but what about the economic case? Why should somebody in New York or San Francisco care when somebody in Africa gets the vaccine?
Well, absolutely, it's the right moral thing to do. But economically, we're not going to have as swift a recovery in the United States or in Europe if we don't make sure that everybody gets vaccinated, because what will happen is this disease, we know it crosses borders. We've seen it all over the world. And so as these variants break out, they will absolutely come back into the United States and Europe and Japan. And so our supply chains won't fully be up and running. We won't get our travel industry fully and leisure up and running, or the business community up and running in terms of travel. So economically, if we're going to reopen the global economy, we've got to take care of this everywhere.
Coming up, Sheryl Sandberg on why diversity and inclusion are top priorities at Facebook.
We believe that this has to be everyone's priority because it's good for our business. It's going to build better products that serve the people all over the world.
This is Bloomberg.
Has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Welcome back to a special look at highlights from the 4th Annual Bloomberg Equality Summit. This year's theme, From Words to Action. After the police killing of George Floyd touched off mass protests last year, corporations rushed to affirm their commitments to diversity. In fact, the hiring of chief diversity officers spiked in the summer of 2020. Will this translate into lasting change? A Bloomberg survey of 100 corporations suggests that representation of minorities within their workforce continues to lag behind. Facebook's Sheryl Sandberg and Maxine Williams spoke with Bloomberg's Pamela Hutchinson about the social media giant's commitment to diversity and why it's critical to business.
I'm in every room because there is the assumption that there are inclusion issues in everything, and you don't want to just go to them when it occurs to you or as an afterthought. You want from the beginning that we are considering that in the way we would every other major issue. So it's integral. So I think that has been the major change for me, reporting to Sheryl and now participating in a broader range of meetings. And I think it's been great in terms of the impact because, again, we can get to things earlier. We have different perspectives in the room. I may know nothing about how to build a product, but I certainly know how the products we build impact the people who use them. And having that insight early on, I think, is just really beneficial to us and to the people we serve in the world.
Thanks, Sheryl. I know you want to say something.
Yeah. Well, 7.5 years ago. And it's actually really fun because Maxine and I have done a million things internally together. But I think this is our first public stage. So I was really excited to share her with the world because she's absolutely incredible. But look, we hired our chief diversity officer 7.5 years ago. The commitment to this has to come from the top. And having Maxine officially reporting to me puts her in every meeting. It puts her in my staff meetings, Mark's staff meetings. But what I would say to other companies thinking about doing this is there's lots of different structures and lots of different ways you can do it. But here's what you have to do. You have to believe it's critical for your business. We have to do this not just because it's the right thing to do, even though I want to be clear, it is. Getting more women into leadership roles, getting more women into your company, getting more people of color into leadership roles and into your company, getting more women of color, because that's where the intersectionality of race and gender makes it the hardest challenges. We have to solve these problems for Black and Latinas, have to, for those women as well. You have to know that it's good for your business, because it is. There is so much data that diverse teams make better decisions, have better results. Look at coronavirus. I've been arguing that we need more female leaders for a long time. The countries run by women had lower death rates. If there was ever a proof point that more diversity of leadership and female leadership mattered, the world just handed it to us. And it's a very sad one, but it's one we should be paying attention to. We believe, not just me and Maxine, but Mark, our product leaders, our CTO, our Women at Group is sponsored by our CTO. Our Black at Group is our exec sponsor, is our head of our business, whole entire sales organization, who's white. We believe that this has to be everyone's priority because it's good for our business. It's going to build better products that serve the people all over the world. You have to believe that. And then everything else falls from there.
Another challenge in Silicon Valley, on Wall Street and around the world, is access to capital for businesses run by people of color and women. In fact, global venture capital funding for women-led startups dropped even lower to just 2.3% in 2020. However, some investors are determined to change the status quo. TPG co-CEO John Winkelried discussed his company's efforts with Bloomberg's Scarlett Fu.
One of the challenges that we face is getting diverse entrepreneurs capital, flowing capital to growing companies that are founded and led by diverse people. Until we solve the problem of putting diverse people into the seat of being capital allocators, running funds, and being able to use their networks to flow capital in that direction, I don't think we'll solve this problem. I don't think we'll make a lot of progress on it. So we've been working on this over the course of the last couple of years, really, and we've now developed an initiative internally at TPG to really brand this and drive this in a more systematic, institutional way. So the objective of TPG Next is seeding, supporting, and scaling the next generation of diverse investors and managers. And we're focused on women, people of color, LGBTQ individuals. So that's basically what it is.
Can you explain how investments in TPG Next differ from what you did with, say, Airbnb or Spotify or any of your other investments in the past?
Yeah, well, I mean, Next is really designed to be sort of the catalyst to get diverse people into seats where, whether it's private equity, whether it's venture, whether it's real estate, again, as you mentioned, horizontal, it's really designed to be the effectively seed and launch managers that will then ultimately go on to be themselves successful investors and successful allocators of capital.
That was TPG co-CEO John Winkelried, and TPG, by the way, also a sponsor of the Bloomberg Equality Summit. Now let's turn to another group that's been hit hard by the pandemic: children who have spent the past year in an environment of virtual education. Access to technology is critical to a student's success, but with vast inequalities in the digital space, millions are at risk of being left behind. Harlem Children's Zone President Jeffrey Canada offered the Biden administration advice on bridging the digital divide.
I think the first thing that the Biden administration should do is admit that digital connectivity is the equivalent of textbooks. And we can't pretend that some kids can learn without it. Whether you're using it all the time or part of the time or seldom, young people have to be able to access information. The other thing I think the Biden administration has to make sure is that families can afford to be connected. There's a lot more we could do if we take this moment and decide, let's really figure out the best practice in online instruction and when that can happen for our children.
Coming up, 2020 was a year of protest against institutional racism. John Rogers is confident that corporate America got the message.
There seems to be just this true commitment to thinking, like, what can we do better?
As for Ken Chenault, he says business leaders' actions have to catch up with their words.
There's some CEOs who have been in place for 10, 15, 20 years who tell me there's a pipeline issue. And I say, excuse me, you're controlling the pipeline.
This is Bloomberg. Welcome back to our special, highlights from the Bloomberg Equality Summit. The headline numbers show the jobs are starting to come back in the U.S., and yet underneath the surface, there are some disturbing trends. The unemployment rate for Black Americans rose in February, while the overall rate fell, underscoring how recovery from the coronavirus crisis remains uneven. Errol Investments' John Rogers told Bloomberg's Sonali Basak that the pandemic exposed flaws in a system that was designed to help minority businesses.
Well, of course, when the pandemic hit, construction halted. People were, events stopped happening, so catering wasn't so important. Buildings closed, their janitorial services were not so.
Okay, ladies and gentlemen, we close position on Bitcoin, as you can see, at 59,345. Because we trade on margin, we have different profit than probably you do. I will show how much we made. For all of you guys, it's worth to hold overnight, as you can see, position, because you made decent profit. You made 1% profit from the level you entered Bitcoin. Well done. Good trade. I'll speak to you later. Stay safe.
So I think that is really at the heart of why things have gotten so much worse lately. And we have to change that and move this term business diversity, which we are doing here actually throughout Chicagoland. Our business community is starting to embrace that term and realize that supplier diversity is literally 40 years out of date.
So we have a question from the audience with a few minutes left, and it's what evidence or signs of hope do you see to move the discourse away from polarized views and towards universalization. Do you see the conversation changing?
Yes, the conversation is changing and pretty dramatically. After George Floyd's murder, the number of calls that I've gotten from CEOs from various businesses to come and speak about diversity and inclusion, there seems to be just this true commitment to thinking, like, what can we do better? On the boards that I'm on at McDonald's, and Nike, New York Times, I'm having much more fulsome conversations with our management teams around what can we do, how can we ratchet up and get more done and really move the needle for the Black community. Where are the holes? What needs to begin? What needs to be done better? So I'm hopeful there. And then finally, we have a progressive congressional leadership, and that is helping. And a progressive president. People often look to Washington D.C. and get guidance and direction. And I think that's also helping to create some real tailwinds that are really creating more equal opportunity for minority entrepreneurs to do well and to maybe finally have access to being a customer. And that'll be very, very important.
From individual conversation, words, comes collective action. A coalition of leading U.S. companies has launched the 110 Initiative, pledging to upskill, hire, and advance 1 million Black Americans over the next decade. Ken Chenault is a co-founder of 110, and he shared why he thinks it will work with Bloomberg's David Weston.
What we felt very strongly is that there was a need to get corporations collectively focused on this issue with a very specific target. 1 million jobs in 10 years. And what that meant was that each company had to make a financial commitment for 10 years and a jobs commitment for 10 years. Because we've got to be persistent at this, David. Many companies have tried this on their own. A few have been successful, but the reality is collectively, large companies have not done a great job on diversity. And part of it is we have to be more innovative and develop some approaches that will allow more Blacks to be in family-sustaining wages. There's nothing more ennobling than, in fact, to have a job. But it can't be a dead-end job.
So this is talking about entry level and above entry level, moving people up the chain.
Yes.
Let's talk about the top of the chain, because this is something that is much discussed, have been for a long time. I'm not sure how much progress we've really made at the top of the companies, and that's C-suite, that's boards, you name it, in terms of really having diversity and inclusion. You have a lot of experience with this, Ken. Where are we at this point? Do you think we have made progress?
I think we've made some progress, but if you look at the numbers, it's disappointing. So, David, there were more Black CEOs in the early 2000s than there are now. I think there were at one point 10 or 11 Black CEOs. I think there are 4. Ken Frazier stepping down from Merck after an incredible career, terrific CEO. But the reality is you would have hoped that we would have had 30 CEOs of people of color. That has not happened. There's some CEOs who have been in place for 10, 15, 20 years who tell me there's a pipeline issue. And I say, excuse me, you're controlling the pipeline. For this upper rung, you can be very focused. You can say, who are 10 people in my organization that I think have the capabilities to move up and really make sure that getting the mentoring, the job assignments, you're holding them highly accountable for performance. But I don't think we've had this focus and we haven't held people accountable.
Equality was a major issue for voters in the 2020 presidential election, and the new chair of the White House Council of Economic Advisors has made it clear it will be a policy priority for the Biden administration. Princeton economist Cecilia Rouse is the first Black American to lead the council. She spoke with Bloomberg's Jacqueline Simmons at the summit.
Structural inequalities is not healthy. It means we're leaving productivity on the table. Just as we know that income inequality and wealth inequality is not helpful to economic growth. President Biden, Vice President Harris are really committed to ensuring that racial equity, that gender equity are infused throughout the federal government, throughout our policymaking. Fundamentally, what we can be doing at the federal level is ensuring that women and other caretakers, but there are disproportionately women, are have the support that they need in order to balance their family responsibilities and their work. And I would also add ensuring that jobs, so, with policies such as the minimum wage, the federal minimum wage has not been raised in 10 years, ensuring that our home health workers have good jobs, that they don't have to be working 2 or 3 jobs and stitching them together in order to make a decent living. So I think those are some of the ways in which we ensure that women, especially people of color, are making a fair wage for fair work.
And that wraps up our recap of the Bloomberg Equality Summit. You can find much more coverage on the newly redesigned and expanded equality page at Bloomberg.com. It features analysis, information, and lots of reporting from teams throughout the global Bloomberg newsroom. Terminal clients can also get there through a new function, EQLY Go. Thanks so much for watching. I'm Carol Masser. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Chang explores how a chip shortage snarled everything from phones to cars on a Bloomberg television special, Chip Crunch, Wednesday on Bloomberg Technology.
It has the makings of one of the tech world's greatest comebacks. Chinese internet old-timer Baidu has pulled itself back from the brink of near obscurity, and it's now on the cusp of re-emerging as one of the country's most influential companies after losing its lead to a string of hard-driving competitors. Bold bets on autonomous vehicles and AI chips are starting to come good. Its smart speakers and cloud businesses are posting double-digit growth. But a government crackdown on China's tech champions is casting a long shadow over the sector. And that competition, well, it's only getting more heated. Now, after more than 3 years, the US-educated founder and CEO of Baidu, Robin Li, has agreed to speak exclusively to Bloomberg TV about his company's transformation and about his future. This is a conversation with Baidu CEO Robin Li.
Looking at almost record highs now for Baidu's share price. Do you see that as a validation from investors for this strategy change, this focus on AI, on autonomous vehicles, on semiconductors?
I think our strategy has not changed much over the past 2 or 3 years. It's that the market takes time to realize that autonomous driving or AI has big potential, and Baidu is having a lead on that. So 2 years ago, or even 1 year ago, when we spent a lot of money in AI, in autonomous driving, it was a negative, impact to our stock price because you lose money by doing that. It hurts your EPS. Nowadays, it seems that investor sentiment has changed. They all of a sudden realize that, this thing has a big future, and Baidu's investment in AI and in intelligent driving will someday pay off. And I'm happy that the market has started to pick up this kind of message. But for us, we've been investing not for 1 year, not for 3 years, not for 5 years. We've been investing in AI for more than 10 years. We probably lost a lot of money by doing this, but I think eventually we will be rewarded by doing this.
What is the rationale then for this secondary listing in Hong Kong?
I think it's quite straightforward. Baidu is based in Beijing, and we want investors in Asia, those who are in the same time zone, can easily invest in Baidu. They can have a better opportunity to grow with us. And, there were U.S.-China tensions for the past few years. I think investors also have this kind of concerns. Although we're not that, concerned about delisting, but I think having another exchange for Baidu stock is overall good for the investors and also good for people around the China area to really share our growth.
And you're really talking about going out on a limb as the business 8 years ago, 10 years ago, to invest in these areas when many others weren't. How much of an advantage then do you think that gives Baidu going forward?
That gives us a lot of advantage because, this kind of technical problems are very hard. It takes time and it takes a lot of money to really get that done. Or I would even say today, we're not done yet. We're far from done. We will continue to invest for the next 10, 20 years, and our pace of investment will not slow down. We will continue to add more to our R&D budget so that we will maintain this kind of lead. AI is a very broad market, and it can be applied to many industries. And there are lots of innovation that can be done when you get into those specific industries. I'm very confident, and also I'm very determined.
What are the growth prospects for the broader business looking like heading into the rest of the year?
This year, we have an easy comp. Last year, because of COVID, our business was affected. So this year, the core business will have a pretty good growth rate. But more importantly, the new business, the new AI-enabled business, be it AI cloud or intelligent driving, it's been growing very fast.
Well, you're right. So double-digit growth is what we've seen in terms of your AI-powered smart devices and the cloud unit of the business. Does that growth continue to accelerate?
Yes, especially for AI cloud. We separately disclosed the cloud revenue. Each quarter, you can see that it's growing very quickly, and the growth rate for Q4 was higher than Q3, and the growth rate for Q3 was higher than Q2. So it's quite obvious.
I believe advertising revenue accounts for about 70% of overall revenues. Non-advertising revenue is clearly increasing, as we just touched on.
Yeah.
At what point do you see non-advertising revenue overtaking advertising revenue? And if so, what time frame?
Yeah, it will happen. I cannot see, accurately which year, but I think the trend is quite clear. This is not, Baidu is not alone. If you look at other, large internet companies, most of them, for most of them, advertising is a minority of their revenue.
What kind of acquisitions might you be looking at this stage?
We think technology is at the core competence of Baidu. We would look for technologies that could complement with our own strategy and technology portfolio. But in the meantime, if we are short of, let's say, operating experiences or talents, those are all possibilities.
And would you be looking domestically for those acquisitions primarily, or overseas as well?
I would say primarily domestic. We were more optimistic about international before, but because of the trade tension, it's increasingly difficult for us to invest in the U.S.
You studied in the U.S., of course. You've built an incredibly successful business here in China. Where do you think the U.S.-China relationship is going ultimately?
My preference is certainly that both countries can work together, and I think by working together, a lot of things can be done faster, and the world will be better off. Like you mentioned, I spent quite a few years in the U.S. I know the U.S. well, and I love my country. I love China. I think for Baidu's success, we obviously are rooted here in China. We will benefit from a very large market and the government policy to encourage innovation. But we also benefit from our U.S. partners. They supply parts. They help us to grow faster. I very much like to stay coupled instead of decoupled.
Coming up, why Robin Li says his autonomous cars could soon be taking on Tesla.
I'm quite confident that we will be able to roll out the most advanced car in terms of autonomy.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
You have a partnership with Geely, one of China's biggest car makers, for autonomous electric vehicles. What is the aspiration with that partnership?
We realized that we have never built cars before, and we need help. And Geely is a natural fit because they are one of the leading car makers here in China. They have a lot of experience. They ship millions of cars every year, and they have a good capability of managing the supply chain to ensure the quality and cost, all that kind of things that we're not good at. when I talked to Li Shufu, the founder of Geely, we are very much on the same page. He wanted Baidu to control this car maker company, and we want to get the expertise from their car making experience.
What's the production time frame? How many units are you targeting?
A car, it really typically would take about 3 years to get a car onto the market. We will try to get it on the market sooner rather than later. It's probably too early to announce a number of units at this time because it's still early, but I'm quite confident that we will be able to roll out the most advanced car in terms of autonomy.
But before 2024, it sounds like.
That's right. That's
okay.
Right.
And you talked about the competition, Tesla, of course, but also Xiaopeng, NIO. We're also seeing the likes of Foxconn, Huawei, Evergrande, all kind of moving into this space. Very competitive.
Yeah.
Is there a risk of this being oversaturated, this market?
There are, but again, I think this is a very large market. There will be many players instead of just Baidu. But what I think most people don't realize that it requires a lot of investment in R&D, in technology. And we started back in 2013. In the future, I think everybody believes that autonomous feature is the most important feature for an electric vehicle, right? And just autonomy itself requires a lot of investment in technology. Last year, we spent about 20 billion RMB in R&D. This is more than any other EV company has spent, and probably more than all of them combined, the companies you mentioned. We are determined to spend a lot of money for the next 10, 20 years to make sure we have the best and strongest autonomous platform.
Sounds like Robin Lee versus Elon Musk. Do you think you'll be able to take on Tesla?
I think we are quite different. We are an open platform. We want everybody to be successful. We don't just want to build our own cars. So in addition to the venture Jidu, we also supply technology to other OEMs. We want them to use our autonomous driving capability too. We will probably also run a fleet. We will run robotaxi. We want the consumers to enjoy true self-driving cars sooner rather than later. We want to save their ride-hailing cost. There are lots of things we can do, and we will partner with people to do that. So this is very different from Tesla.
Okay. I want to get more on the AI chips focus, because that's really interesting. You've raised about $230 million to develop the chips unit of the business. What are you hoping to achieve ultimately?
Well, it actually started quite a long time ago, probably 10 years ago, when we were running a very large server farm, and we need to customize some of the servers so that it will run faster or cost us less. And we found that by designing our own AI accelerator would do that job. So we started this kind of chip design quite a long time ago with a very simple reason. We want to save money for our servers. So starting from last year, we had our first Kunlun chip on the market. It's not really on the market because over 50% of the chips was used by our own server farm. But it served the purpose, right? We didn't have to pay a very hefty price for third-party, high-end AI chips. We could use our own. It saves money and runs faster. It fits our needs better. But then all of a sudden, I realized this is not just for Baidu. It's actually a lot of industry, a lot of other companies also want this kind of high-end AI chips.
And we're seeing that chip shortage play out globally right now. So it seems like a good move. The Kunlun chip is a 7 nanomillimeter chip. You've said you're going to start mass production this year. Has that started? And where do you see most of the demand coming from?
Yeah, the 7 nanometer one is Quinlan 2. It's coming up this year, and it's being produced by the fabs. So we do expect that the performance will be 3 times better, and the internal demand is already there. The external demand, we found that is quite strong because, as you mentioned, there's a shortage on high-end chips.
Can you specify which sectors you expect to see most demand from?
It crosses many industries because AI can help in a lot of scenarios, in a lot of cases, and wherever you need high-end chips, be it a data center or edge computing for smart transportation, for energy sector, for education, or for finance, they all need this kind of high-end chips to do complicated AI.
Have there been any discussions internally about spinning that unit off at some point?
Depending on how you define spinning off, we already raised the outside money, so that operation will be run more independently than before. But Baidu is still the controlling shareholder. We will still support them wholeheartedly.
And this focus on AI and on chips dovetails with government policy, the 5-year plan. How much of that is by accident, by coincidence, by design? How helpful is it?
Well, on the surface, I think it's more like by accident. As I mentioned, we started this like 10 years ago, purely out of our own needs. We just want to save money. But along the way, we gradually realized, this is much more important than just internal use. The whole country, a lot of companies also need this kind of high-end advanced chips. As AI is being adopted by many industries, as people continue to realize that higher computing power can generate better AI results, the market demand skyrocketed. So we feel lucky from this perspective, but it's also kind of more like designed because we are a technology company. Our mission is to make the complicated world simpler through technology. This is one of the most important technology in the AI era. If not us, who else can do a better job?
Coming up, China's regulators crack down. Alibaba's been hit. Tencent is in the spotlight. Could Baidu be next?
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
regulators here are now squarely focused on an anti-monopoly regulatory change, reining in financial technology. How do you think the technological regulatory environment is going to change in China? How is it going to impact a business like Baidu?
The country has never emphasized innovation more than they do today, right? Innovation is at the center of China's modernization, according to the official documents. And I think companies like us, we invest, more than 15% of our total revenue every year to do R&D. I think the government like that. And in the meanwhile, I think antitrust is also good for innovation. You just cannot imagine, the number one and number two guy all of a sudden merge and gaining more than 90% of market share in the US. But that happened quite a few times in China before. That's not good for innovation. So I think that the antitrust push is kind of justified.
Baidu has been fined recently for what the regulators say are monopolistic practices, for not flagging deals to the regulators. Is there a risk that you're going to have to unwind some of your deals?
That's not very accurate to say, because the law probably requires a certain kind of deal seek for approval, right? For that particular deal, we did not seek for approval in time, and it doesn't mean that we had monopoly practices. The fine was not for that. And I also think it's not right for the government to block every deal, right? Certain kind of liquidity is also good for innovation. You just cannot do monopoly things.
Are there steps that you're taking now to adjust to the new regulatory environment here?
Yeah, if we do a deal of large scale, we will seek for approval in advance.
The government is also encouraging companies to open up their data. How do you think that is going to play out? Has that started yet, that drive?
It's very much in line with our belief. We run a lot of open platforms. For autonomous driving, it's Apollo, right? For AI in general, we have Baidu Brain, which is also open. We have PaddlePaddle, the most popular Chinese deep learning framework. Those are also open source. We want a lot of people to use our platform. We're open to everyone. In a lot of cases, it's free for them. It's not only good for the society, it's also good for us. We get a lot of feedbacks.
A lot of the focus has been on Alibaba and Ant and Tencent. Do you feel like Baidu is better off in some ways, that you're slightly sheltered from this?
Well, I can't speak for them, but like I mentioned, we like openness. We want to share data with other partners, and we think that's good for our technology too.
Another big topic here that involves technology, a lot of debate online about this, is the 996, the almost more than 70-hour work week that many technology companies and their employees go through and is the reality for many people. Do you think that push, that drive, the amount of hours that people have to put into their work in tech companies here, do you think that has to change? Do you think that needs to be rethought, 996?
It depends. If the employees are voluntary, I think that's okay, especially for those young people. If they want to become more successful, they need to work harder than their peers, right? This is just natural. But if from a company perspective, if you demand them to do 996, I think that's wrong. I think employees have the right to work and to rest and to enjoy life. It's their choice. And at Baidu, we have this kind of philosophy, right? It's really up to you. If you want to work harder, we welcome that. If you want to enjoy life, that's okay too.
I want to switch focus really to you and your future. We've seen some changes at the top of some of the big tech companies here in China in terms of leadership, some big names stepping down, making way for others. Is there a succession plan at Baidu?
I always wanted to find someone who can replace me as CEO. But in the meantime, I do enjoy my current work. I like technology. I like to see all the changes happen. I like to see, our technology can contribute to the society. So whether I'll be the CEO or not, probably it's not that important. It's just as long as I'm doing things that I like, I will be happy. But having said that, I increasingly spend a lot of time these days to work with the Baidu people so that their capability keep improving, especially in the innovation front. I think I need to train them. I need to inspire them to become more innovative. That's over the past year or so, I spent a lot of time on that.
Okay, so you've been looking for a CEO. Who is your number two, though, Robin?
I wouldn't rank our executives from number 2 to number 10. They're all very talented, hardworking, and has big potential. I want them all to grow and become better, and more successful.
But you're in no rush to retire anytime soon, it sounds like.
If I have to stay on the CEO position, I will.
Robin Lee's ambitious bets on chips and driverless cars has positioned his company to reap the rewards of the next technological revolution. But competition is intense. US-China rivalry could upend the sector, and China's regulations, well, they can change on a dime. Robin Lee will need all the skill and luck he can muster to cement Baidu's position at the top of China's AI table. That was a conversation with Baidu CEO Robin Lee on Bloomberg Television. I'm Tom McKenzie.
Tell us something you're doing that doesn't work out, where you've failed or something you can say you're not good at.
Let me tell you something. There is plenty that I am not good at and plenty that I've failed at, but I'm not afraid to fail.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
We're actually in the period right now where the global economy is starting to accelerate and growth numbers are positive.
It's very mechanically driven, completely unnatural as far as recessions go. So now the recovery is somewhat unnatural as well.
All those who were saying that we were going to get inflation like you've never seen so far has been proven wrong.
I think we're going to see the strongest economic growth in 50 years during 2021 and 2022 combined.
At the stock level, we're expecting disappointment. I mean, we think it's going to be difficult for a lot of companies to manage this.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's a simulcast. Bloomberg Radio, Bloomberg Television. We say good morning. Jonathan Farrow, off. A well-deserved sabbatical for Mr. Farrow. And we're thrilled that Romaine Bostick comes over from the dark side and joins us in the early morning as well. Here's what we have this morning, and we say a sincere Passover and Good Friday to all of you around the world and across this nation. We are here because of Jobs Day, and Lisa Abramowitz, can I be honest, and help me if I'm wrong?
Are you ever not honest?
It is a celebration of this labor economy?
Well, hopefully it will be a celebration. If you take a look at the ranges and some of the higher expectations of more than 1 million jobs that are expected to have been created in March, it's supposed to be a celebration. Interesting to see how much that celebration has legs, Tom. How much are we going to see the longer lasting jobs created versus the nature of just a shocking rebound and the lower wage jobs coming back on as people get on planes? And that, I think, is some of the data that economists are going to be parsing out this morning.
And
Tom.
there's some nuances here we're going to dig into, folks. Of course, everybody focusing on 8:30 this morning, and the confusion is usually all the markets close Good Friday, but Romaine Bostic, it's a split decision. Equities closed, but we're going to get some view from bonds.
Yeah, you're going to get some views from bonds. You get a little bit of a view here from equity futures here. Volume light, about 30,000 pretty much on the S&P futures right now. You get a bond market that's going to open, I'm told, sometime around 8 a.m. It's going to close, I'm told, sometime around 12 p.m. So you can sort of get your trades in between there. We've seen volatility on days like this where you have a shortened trading session in the bond market on previous Good Fridays, on previous July 4th Fridays where we've gotten these jobs reports. So something to keep an eye on here. We talk about a celebration, Tom. Let's keep in mind, this is still a bit of a restoration here when we talk about what we're looking at in the labor market.
Well, it's a restoration, and of course, we'll go into the nuances. Julia Coronado to join us here in a moment, but I really want to say, folks, we will go through the morning, and it's a special edition with 4 hours on radio and television, and with this 4-hour marathon that we're doing, Lisa's calling it a marathon.
This is 4 hours?
Yes,
no one told me that.
when you signed up.
Wait a minute. I got suckered into this. Where's Farrell?
We said to Romaine,
now I know why Farrell took off.
Yeah, we said to Romaine, 8:35, see ya, you're gone. Forget about it.
I thought this was like a 2-minute hit.
But Lisa, we can frame, Lisa, let's get back on the rails, team. Lisa, we can frame the conversation for this Q2, and it is all centered on the outcome of a boom economy.
Yeah, and how much that has some lasting power, particularly when it comes to inflation. I just want to make one note, especially since Romaine is here. It does seem like bonds are the active group and that stocks are just a little bit lazier. Just saying, bond trading is always open on some of these holidays, but definitely it'll be interesting. And coming up this morning, let's talk about what we can expect today. 7:30 a.m., we've got Morgan Stanley Chief U.S. Economist Ellen Zentner, who will be joining us on Bloomberg Television. And then at 8:30 a.m., as we were talking about, we do have that payrolls report that will be highlighting how much we saw a rapid reopening in March. That'll be really interesting to parse through and see how much is really just concentrated on the leisure and travel areas versus some of the longer lasting trends. Then 9:30 a.m., this is going to be a joy, to quote you, Tom, to channel your rhetoric. U.S. Labor Secretary Marty Walsh is going to be speaking here on Bloomberg Television. Interesting to see how he expresses optimism about the labor market, yet still reiterates the need for a $2.25 trillion plan, Tom, to try to get the economy going over the longer term.
And of course, someone we've spoken to many times before, Good Morning in Boston on Bloomberg Radio, as your mayor moves to Washington to drive forward the Biden conversation on labor. We're thrilled that Marty Walsh will join us. Let me do the data right now, and of course, it's a truncated data check. We've got futures up. I want to talk to Romaine about that throughout this hour. In the bond market, well, it's a churning, I guess. Guess what? It's not open, but there we are with a 168 bond yield, rounding it up. 2-10 spread doesn't give me much information. In oil, I've got nothing going on. In the litmus test, a litmus paper rather, of the global market, dollar, well, a little bit weaker over the last few days. Mark McCormick with us with TD Securities with that strong dollar call, that resilient dollar. And I would note Euro 117.82. That was, Romaine, I think that was the lamest data check I've ever done. That got the Bostic F,
It wasn't your best. But look, I mean, you got the markets relatively close here on this day. And those four things you had on the board, Tom, just keep in mind, for a lot of folks here, this is what a lot of people are looking at as sort of the next leg of a potential market cycle, potentially the next leg of an economic cycle.
And we thank Kieran for bringing in the mimosas as we celebrate this Friday of a labor economy.
Cheers, Tom.
I didn't get one. All right.
He's just going to keep drinking.
Yes,
let everything go.
Well, you know, it's good orange juice. Julia Coronado gets us started, and we start strong. Dr. Coronado with macro policy perspectives to review at BNP Paribas a few years ago. She had the call of the year on slower GDP. This is ancient history. She was barely out of Texas, but I can assure you she has been extremely good at the measurement of the economy. Dr. Coronado, good morning to you. One thing, and this goes back to your time at BNP Paribas, does the zeitgeist right now overemphasize or miscalibrate the recovery?
That's a great question, Tom. And I think Lisa put it right earlier. We are going to get a surge. I mean, it seems mechanically a done deal, just given the amount of fiscal support in the pipeline and the reopening dynamic that's already taking hold. So we're going to have a strong year. We're going to see some really strong job numbers. And then the question is, how are the fundamentals after that reopening phase of the recovery? Do they go back to sort of the slower growth, demographically driven dynamics, or do we have sort of a longer period of stronger growth and maybe some stronger productivity given the transformation we've seen during this cycle?
All right, so Julia, help us understand what tea leaves to look for in this March report to determine exactly that, the longer lasting seeds of perhaps a recovery in the labor market that goes beyond just a reopening with leisure and travel.
I mean, it will be difficult to read all of that from this month's report, but what we will be looking for is how broad-based the reopening is, or the job gain is. How much is it concentrated in leisure and hospitality and the lower wage jobs, which we do need to bring back. So we want to see those jobs coming back. Those are the workers that have been hardest hit. But if we see stronger numbers across the board in professional services, in other manufacturing, construction, across the board, what we're looking for is those permanent jobs. We can also look at how much of the reduction is people coming back from temporary layoff. This is a reduction in the longer term unemployment. That's key because the longer term unemployment has risen and been very sticky at a pretty high level.
Julia, I am really a lot more interested in that. I mean, we'll see the bump up in some of those services industries here. When we talk about some of the more stable industries, the industries that actually didn't shed a lot of jobs during the pandemic, and what type of growth we're going to expect out of them heading deeper into 2021 and more importantly into 2022. That hiring pace, that trend line that we had seen prior to the pandemic wasn't necessarily strong. What is there out there to make us believe that it will be strong going forward?
We have seen a lot of investment. So last year, one of the big positive surprises was a robust rebound in investment. We are now seeing levels of investment above the pre-pandemic levels. So we are seeing the recession as a catalyst, being used as a catalyst for business transformation. And so that's really very interesting for us to watch as economists. That could speak to not just buying a bunch of laptops so that people can work at home, but something more profound, something more fundamental, where we're going to see, again, that rise in productivity and profitability in different business models and different industries.
Julia, within this boom, and everybody's talking up a boom economy, are we going to see a true labor constraint? Do we have industries where we're actually going to see a shortage of labor?
I am not particularly worried about that, Tom. I think one of the lessons we learned from the last cycle was that the labor market is extremely resilient and very elastic, and people learn and move and take jobs even after they've been years out of the labor force. And we have millions of people who have left the labor force who only recently were employed. So I'm not that worried about labor constraints. I think we've got miles and miles to go before we see anything like that.
Dr. Coronado, thank you for getting us started strong today. Julia Coronado with Macro Policy Perspectives. And of course, lay out the plan here, folks. We're going to go through the morning looking at, the beginning of this second quarter and where we are in the global economy, many other stories besides the labor economy, but we are focused on the 8:30 jobs report. Julia, right, 3, 2, 1. Lisa.
How's that mimosa going?
Yeah,
Tom?
the mimosa's good. Yeah, it's got the little strawberry thing up top.
Oh, you got the strawberry one.
Yeah, Afterthought told me to overlay with the strawberry on top of the mimosa. Lisa, when I look at the jobs report, the bottom line is we need to jumpstart finally to this better economy. Is March the month in your reading?
Well, I mean, this is basically the assumption among a lot of economists, including Morgan Stanley, coming up with Ellen Zentner. Just to give you some numbers, though, the median consensus, 650,000. The range spans, get this, from 232,000 to 1.1 million.
That says it
to
all.
give you a sense of just how big this range really is. The unemployment rate's expected to come down to 5.9% from 6.2%, so material increase in gain there. This is what I think will be interesting. Hourly earnings may be skewed to the downside because a lot of the people being brought into the labor market are the lower wage workers. So that's going to be a little bit skewed. And I think people are going to be looking to that to figure out how much this economic recovery has legs, at least in the near term, Tom.
Romain, is the market ahead of the economy right now?
The market's been ahead of the economy for a long time now, Tom. I mean, you saw the 4,000 print yesterday on the S&P 500. This is a market that has already priced in the economic recovery. But they'll also tell you, Tom, that there's something much more structural, much more long-term unfolding here. Whether it shows up in this month's numbers remains to be seen.
All of you worldwide and across this nation, we welcome you to Bloomberg Surveillance. We're going to be with you for not 3. Pharaoh demands that we do 4 hours today, so we're going to do it. Jobs Day at 8:30. We welcome you on this moment for America. Please stay with us. Romain Bostic, Lisa Abramowitz, and Tom Keene. Good morning. Good Friday morning. This is Bloomberg. Good morning.
With the First One News, I'm Ritika Gupta. Iran and the rest of the world powers still in the 2015 nuclear deal will discuss a possible U.S. return to the accord. There will be a virtual meeting today. Amongst those taking part, the EU, China, and Russia. The U.S. says it welcomes the effort. Iran has insisted that the U.S. must drop sanctions as the first step. A top White House aide will lay out U.S. strategy towards North Korea and Kim Jong-un today. National Security Advisor Jake Sullivan will meet with his counterparts from Japan and South Korea at the Naval Academy. President Biden has warned the U.S. will respond if Kim escalates recent missile tests. And the Justice Department investigation into Florida Republican Congressman Matt Gaetz reportedly focuses on cash paid to multiple women. According to the New York Times, the women were recruited online for sex. Gaetz has denied any wrongdoing. More problems for AstraZeneca's coronavirus vaccine. The British government saying that there have been 25 new reports of blood clots linked to the shot. That's adding to the numbers that caused European countries to impose the restrictions on the vaccine. Pioneer Natural Resources is expanding in the Permian Basin. It's agreed to buy Double Point Energy in a deal valued at $6.4 billion in cash and stock. It's one of the biggest American oil takeovers this year, and it comes just less than 3 months after Pioneer bought fellow shale driller Parsley Energy. It's a match made in tabloid heaven. The South Korean company that launched K-pop sensations BTS is buying the U.S. media group behind the careers of Justin Bieber and Ariana Grande. Big Hit Entertainment is spending a little more than $1 billion to acquire Ithaca Holdings, the parent of Atlas Music Publishing. Ithaca is headed by record executive Scooter Braun. Global News 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Asia is absolutely core to our business.
It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Ultimately, it's billions of dollars from the government that will pull that vaccine through and purchase it for Americans and people in low-income countries.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
I think that the idea that we're going to just keep doing things and never paying for them, if you want to come forward with different ideas of how to pay for things, as long as you recognize that 400K boundary, we're willing to listen. Jared Bernstein, he is one of the liberals the conservatives listen to. Of course, decades of work in Washington on public policy, an advisor to Vice President Biden, and now the Council of Economic Advisors. We welcome all of you this morning. Lisa Abramowitz and Tom Keene, Jonathan Ferro, well-deserved sabbatical for Mr. Ferro, and thrilled that Romaine Bostick would join us today here on a Jobs Day. Right now on Washington, Mr. Bernstein's Washington, Kevin Cirilli joins us, our chief Washington correspondent. Kevin, there's going to be a Jobs Day. There is a boom economy. Let me start with, I guess, square one. If we have a boom economy, why are we talking about billions and trillions of stimulus?
Well, they feel that they have to spend in order to keep the recovery moving. But, I was struck yesterday by Senate Minority Leader Mitch McConnell's comments in Kentucky, in which he said that he doesn't see any Republicans supporting what he's described in the past as a Trojan horse of an infrastructure plan. In contrast with that, I've got my eye beyond just the bickering back and forth and the partisan front of this, because there's legislation like the New Frontier Act that Majority Leader Schumer is working with Republicans on, and in the House, you've got another coalition forming, and that's really where I think the China money is going to move.
All right, so let's talk about some of the aspects of this plan that are getting debated currently. Nancy Pelosi coming out and saying that she actually was throwing her support behind the repeal of the state and local tax deduction. This was the $10,000 cap that